AI is a bubble. We're starting to see that cash flow headroom coming down.
It's still going to drive markets. There is a fair amount of capital on the sidelines.
The theme is the same theme going into the internet boom. If you're not exposed, you're really going to miss out.
I still think there's a lot more buying opportunities and money to go into the equity markets here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome to Bloomberg Surveillance. Traders are struggling to find that Santa rally as worries remain about overvalued tech stocks and a potentially stagflationary backdrop. Bitcoin at the epicenter of froth coming out of the system, with the asset seeing a more than 25% plunge in the past 2 months. And OpenAI's Sam Altman feeling the pressure as he reportedly declares code red in his race to compete better with behemoths such as Alphabet's Gemini. Definitely front and focus as we look at the competing AI chatbots that are getting ground.
Everyone's been talking about the fact that this is an AI arms race. And now it feels like the pressure is really percolating ever more so on OpenAI and Sam Altman. How are they going to beat Google? This comes after Altman recently also told employees privately that Gemini could cause, quote, temporary economic headwinds for OpenAI, and talked about basically rough vibes right now at the company as they try to compete. Remember, there was a code red moment for Google, and now the tables have turned, and Sam Altman is dealing with his own version of that.
I love it. Last week it was bad vibes, man. This week it's code red, and a real question here as they try to justify some of the capital structure that they've really created for themselves. It kind of goes to this question of how much willingness is this market going to have to really fuel any additional taking on of debt markets. We're going to be talking about that throughout the morning, but also this question of how much froth is coming out of the system. I know we don't normally talk about Bitcoin, but the fact that you've seen a 30% plunge since recent highs in October just highlights how much you're seeing forced selling, how much you're seeing a potential retracement for some of the high flyers earlier this year.
Well, I think it's just writ large in the market, potentially maybe some risk coming out. You're asking about where's the Santa Claus rally? Well, what is the next catalyst to drive this market? We don't have jobs this week. We're basically waiting on, is the Fed going to cut? Are they going to pause next week? And then potentially there might be some relief. At the same time, the string of data we are getting isn't that great. Look at ISM yesterday, 9th consecutive month that we've seen some pressure when it comes to manufacturing in this country. And remember, this was supposed to be the year of tariffs and sticks and shovels and manufacturing coming back into the United States.
Yeah, you had, on one hand, the decline at the headline level, and then you had ISM prices that inflected upward. A bad mix, which is the reason why yesterday you saw the biggest one-day pop in 10-year yields going back almost a month. Right now, you're seeing a bit of a continuation of that same trend, albeit really tempered. Not a lot going on. If you're looking for action, today probably isn't it. You are seeing S&P futures up about 0.25% near session highs. You are seeing yields also continuing their climb, albeit barely 4.09% rounded up on the 10-year. Really, it is a quiet morning as we try to get a sense of what the actual data is ahead of what should be non-farm payrolls. I keep going back to this. We should be talking about payrolls this week. Instead, we're talking about what? AI? We're talking about what? Venezuela?
This is the problem. Self-inflicted wound almost by Washington, D.C., when we could have had a drumbeat on economic data. Self-inflicted wound potentially if the Fed goes on pause because they feel like they don't have all the economic uncertainty. Why didn't you just make the individuals at the Bureau of Labor Statistics essential so then we could have kept the same cadence when it comes to the economic data? That's all I'm going to say.
We're still in the anger and the rejection of not getting some of this economic data. Hopefully we'll get to acceptance and moving forward. Coming up this hour, Cameron Dawson of NewEdge Wealth with risk appetite taking a breather. Geetha Raghunathan of Bloomberg Intelligence's Netflix makes another all-cash bid for Warner Brothers, and Tom Fitzgerald of TD Cowen after cutting his estimates on the major airlines. We begin this hour with stocks trying to get some sort of gain as markets look for direction heading into year-end. Cameron Dawson of NewEdge Wealth writing, the market is still sending a pro-growth, pro-cyclical message. There is lots more room for investors to get more overweight this market. Cameron joins us now. Cameron, wonderful to see you. Thank you for being with us.
Thank you for having me.
So what's going on right now? Why are we seeing that Santa rally not materializing, even though this is typically the moment where people put aside their worries and buy?
Well, we are still seeing that investors are sitting on the sidelines of this market, mostly in institutional investors. And we feel like a bit of a broken record in saying that institutional investors are just neutral, which just means that there is still room for them to get dragged back in. However, the caveat is that household investors, individual investors, have been all in this market, and they have made up the majority of the trading this year. They have been the incremental buyer. So as you see volatility in things like Bitcoin and meme stocks and non-profitable stocks, that is hitting that that individual investor and likely some of the source of some of this volatility. But we think because you still have institutions sitting on the sideline, it means that short and shallow dips are likely what we get simply because there is room for people to get more invested.
So let's just start with an anatomy of what's going on right now. How much more retail selling is there? How much are we seeing forced liquidations of things like Bitcoin funds or things like, potentially the more frothy segments of the AI trade?
Well, the most startling thing for us is that if you looked at FINRA margin loan growth over the last 6 months, it was growing at a 35% pace. That's faster than the pace that we had in 2020 when rates were 0%. So you clearly had this ravenous risk appetite go into markets. And so you start seeing things like Bitcoin sell off in a more meaningful way. And we look at it and say, hey, no crying on the yacht. When you play with fire, you are likely to get burned. And we've been seeing Bitcoin diverge very much from some of these meme stocks and speculative stocks really for the last 4 or 5 months. So some of this was preceded by the price action that we were seeing in Bitcoin, even as you were seeing new highs in October and September.
We started out talking about OpenAI and this code red. What kind of signal does that send for the broader market? Do you think that is a cause for concern?
Well, the biggest takeaway for us is that this is actually a competitive market. That's the takeaway, is that you have businesses that had been operating in near monopolies with huge return on invested capital, which means that they didn't have to invest a lot, but they got a lot of return for that investment. Now this is a very different world. The fact that you see this arms race at the same time as you have this leapfrog and jump of capability with Gemini versus OpenAI, it shows you that AI is highly competitive, which suggests to us that there's less pricing power and that there's less return on the investments that they're making potentially.
So at that moment, do you want to take money off the table when it comes to AI if you don't know who's going to win the race?
Well, look, we're still very much in this CapEx build-out cycle. And what we've been arguing is that the CapEx cycle is going to be very different than the application cycle. And the beneficiaries of those two things could also be very different. The challenge that we have is that if we look at this market and we look at the economy, it's all become incredibly indexed to AI, where the growth in the economy is sourced from AI and the growth in the market is. One of the most fascinating things is that if you look at the Russell 1000 Value Index, it got rebalanced earlier in this year. It added 3 Mag 7 names to it, and now the largest weight in the value index is Google. So we now own all the same things. So even as you're trying to diversify, good luck, because when you buy value, you're now getting Google.
There is this theory that if you do have the build out of AI, this will ultimately lead to a manufacturing renaissance in the United States. You're laughing with this absolute skepticism. And I think a lot of people would join you after seeing the ISM manufacturing numbers yesterday, where the headline number came in at the lowest level going back to July. You have prices paid going up. This is stagflationary. Yeah. This isn't necessarily what people want to see. Why are we not seeing the right kind of manufacturing boom that seems to be implied by the AI build-out?
And isn't it fascinating that we've now had OBBB for nearly 9 months or over 6 months, and you're not seeing that show up in any of the manufacturing data, meaning that accelerated depreciation was included in OBB. It's kicked in. This is supposed to incentivize people to invest more. It's not necessarily resulted in broader investment. Certainly, it's helped the AI players who are already making these investments. Now, I think it's important to note that PMIs have not been a good leading indicator for what we're seeing in industrial and manufacturing profits. You've effectively been in a contractionary PMI for the last over 3 years, and yet you see industrial profits that remain very strong. So it's likely a reflection of the fact that watch what they do, not what they say. Sentiment surveys are much more dire about the outlook than what we're actually seeing activity.
At this point, though, don't you think that this is something that we need to pay attention to in terms of that type of dynamic? Because it is a global dynamic. This idea that everyone wants to invest in manufacturing. Everyone's going after the same materials, and they're in scarce supply with particular supply chains. And you have, this real question of whether that kind of reaction is coming from as much Japan as it is in the United States. This idea that they're going to have to raise rates because of inflation at the same time that growth isn't really taking off. This feeling that that is going to be the backdrop kind of globally.
Yeah, and I think the takeaway is that the digital world is actually very physical, and you're starting to see the uplift in some of the industrial commodities that we should watch very closely. So as you see things like copper prices move higher and other broader industrial commodities, not just what we're seeing in things like gold and silver, that suggests a little bit of an underpinning of an inflationary dynamic. And that would be very different than this sort of deflationary dynamic that we've been in really for the last 15 years, where you haven't seen much movement out of the commodity side of things.
Cameron Dawson, you're going to be sticking with us for the entire hour. I'm so glad to to say that. Cameron Dawson of NewEdge Wealth. We are just getting a headline, Annmarie, about how U.S. envoy Steve Witkoff has arrived in Moscow. This is being reported by TASS. This real question on this ongoing quest for some sort of resolution to the Ukraine-Russia conflict.
I would say this is a really important meeting because it comes on the heels of Witkoff and Secretary of State Marco Rubio sitting down with their Ukrainian counterparts just this week in Florida, getting their input on this peace plan, and then having this discussion with Putin. Putin, though, has been very matter of fact of what he will and will not accept. Can Witkoff convince him that there is going to be need for more flexibility and obviously understanding of where you can actually get to an end goal, because the Ukrainians and the Europeans are not signing up to that original proposal?
Yeah, it feels like Marco Rubio is playing the Ukrainian side and Steve Witkoff is playing the Russia side, and we'll see where they meet in the middle. We'll talk about that coming up, as well as the potential investment implications for Europe, which is something a lot of people have been focused on. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Nearly half of Chinese flights to Japan have been canceled for December. CCTV reporting that more than 1,900 flights were scrapped due to the dispute between the two countries. Japanese cities Sapporo and Osaka, which rely heavily on tourism, saw the biggest cut. Meanwhile, the White House has defended the Pentagon's handling of a September attack on a suspected drug-running boat off South America. It's denying a report that Defense Secretary Pete Hegseth had given an order to kill everyone on the vessel. Spokeswoman Caroline Leavitt confirmed 2 strikes on the ship, but says the order for the second attack came from a U.S. Navy admiral, not Hegseth. And Samsung unveiled its first trifold smartphone, which can unfold into a larger tablet-sized device. The company plans to sell the phone in the U.S. as well as China, Taiwan, Singapore, and the United Arab Emirates. The announcement comes several months ahead of when Apple is expected to announce its first folding iPhone. That's your Bloomberg Brief, Lisa.
Thank you so much, Yahaira. I never understood why a folding phone would be a game changer, but maybe I will be proven otherwise. I don't know. Have you tried it?
I haven't tried it, but maybe because the phones are becoming now bigger than your pockets, bigger than your purses. Maybe you could have the actual tablet size you want, but make it easier, more accessible to carry around with you. That's my thinking.
Yeah, maybe you could just chip it into your brain and everything will be just fine.
I think Elon Musk is actually working on that.
I think that's coming up next. That's the next iteration. Up next is Not That, pushing for peace.
Special Envoy Witkoff and Secretary Rubio and the Vice President and the President himself, Secretary Hegseth as well, have been working so hard on this effort. They had very good talks with the Ukrainians in Florida, and now, of course, Special Envoy Witkoff is on his way to Russia.
Bloomberg's Mika Solner and Peter Smolinski are both joining us next. This is Bloomberg Surveillance. Maybe there actually will be a melt up into year end. Right now, what we're seeing in futures is that melt up with futures near session highs led by the NASDAQ. So a real possible reprieve for some of the more sensitive stocks to the AI story, up 0.4% on the NASDAQ. S&P futures up almost 0.3%. You can see the Russell 2000 outperforming here, up 0.6% after really getting hammered yesterday. You're seeing a reprieve in the bond space as well. Yesterday, you did see a pretty significant sell-off, at least at the longer end of the yield curve, in response to what we were seeing possibly from Japan. I'm not sure. Also, potentially the ISM. Today, you're seeing a bit more quiet at the 2-year 3.53, 10-year 4.09%, just slightly higher in terms of yields. 30-year yields, though, lower, and definitely giving some sense that maybe we have reached a calm and maybe a yield curve flattening, at least coming from Japan. Under surveillance this morning, pushing for peace.
The administration feels very optimistic. Obviously, the president's entire team, including Special Envoy Witkoff and Secretary Rubio and the Vice President and the President himself, Secretary Hegseth as well, have been working so hard on this effort. They had very good talks with the Ukrainians in Florida, and now, of course, Special Envoy Witkoff is on his way to Russia. We do feel quite good, and we're hopeful that this war can finally come to an end.
Here's the latest. U.S. Special Envoy Steve Witkoff is set to meet with Russian President Vladimir Putin with a renewed push to end the war in Ukraine. Russian state media reporting the talks will take place this afternoon, with headlines crossing that Steve Witkoff has arrived in Russia. Our team coverage starts right now with Bloomberg's Mika Solner in Washington and Piotr Skolomowski in Warsaw. Mika, I want to start with you. What is the ultimate goal here? Do we have a sense of what was resolved in those Mar-a-Lago discussions with the Ukrainian president?
Yeah, I mean, as we just heard Caroline say, the White House is feeling very optimistic in where they are right now in terms of this push for peace. They are trying to meet an aggressive deadline. They're trying to move as fast as possible, but I think they feel like they're in a good place. They put a lot of pressure on Ukraine to accept the deal. There's been a lot of back and forth, but they've also made it clear that they're going to continue working equally with both sides, Ukraine and Russia, when it comes to trying to figure out a plan that's going to end this 4-year-long war.
Piotr, what's the feeling over in Warsaw, in Europe, at a time when they really haven't been included in the conversations? A real sort of existential fear of what could happen if Ukraine is forced to give over more of its land that possibly hasn't even yet been occupied?
Yeah, the simplest way to put it is basically Europe has been horrified by, first of all, seeing the 28-point plan that was revealed, and it had no input from Ukrainians, it had no input from Europeans. And since then, Europeans were trying to kind of influence the talks in some way. And they probably managed to get some inputs themselves by trying to influence talks and trying to steer the document closer to what is now known as 19-point plan, which also Zelensky yesterday said it looks better than what was initially presented. But still, Europe is very much concerned. That's what we heard from Europe's top diplomat yesterday, Kaja Kallas, who pretty much said, we are really concerned that Ukraine will be presented with sort of a lopsided plan where the weaker side, which is Ukraine, is going to kind of bear the brunt of most of the concessions, and that's the biggest concern from the European side, because obviously it's not only geopolitical situation and the risks that there are for Europe from that war, but also the fact that Europe bears the most expenses when it comes to financing the war going forward. So they are really worried that they will be left to handle this war going forward, to pay for it, but also be in a much worse position.
Mika, I'm just curious how much it actually is true that it seems like Steve Witkoff is playing the Russian side and Marco Rubio is playing the Ukrainian side, and President Trump hasn't yet fully made up his mind which one to lean into.
Well, the administration has received a lot of criticism in how they have gone about this, as well as, there's a lot of hopeful members as well on Capitol Hill and beyond who are hoping that Trump can actually bring an end to the war. But there are a lot of people, Trump allies, even Republicans on Capitol Hill, top Republicans, who have said that the president is leaning too hard into appeasing Russia and that there are major concerns about Ukraine's future when it comes to the proposed plan at hand.
Bloomberg's Mika Solner in Washington and Piotr Skolomowski in Warsaw. To both of you, thank you so much. Cameron Dawson of NewEdge Wealth, we are lucky to still have in the studio. And I'm wondering, Cameron, how much you could take a look at what's going on and say this will actually potentially either revive faith in some sort of European recovery or potentially, in a pessimistic scenario, do the opposite.
Yeah, we're watching really closely the stock price of Rheinmetall as a way to kind of gauge all of this and fears about European defense and how much they'll have to do themselves. Of course, what you saw at the beginning of this year is a massive rally in European defense stocks because of this fear that the U.S. wouldn't be there and that they'd have to pay for it themselves. But what that resulted in is a stock like Rheinmetall going from 20 times earnings to 55 times earnings at its peak. And guess what? The earnings estimates actually didn't change at all because there wasn't any near-term benefit to the overall earnings because of this dynamic. So that has now come off the boil. You have a stock like Rheinmetall trading below its 200-day moving average. It looks a little bit toppy. So it's not necessarily showing that kind of fear yet back in the prices of the stock.
What about oil, though? Isn't that one of the major ways to trade this? Because there are considerations from this administration. They always dangle with the carrot and stick approach that there will be, but maybe secondary sanctions on individuals or countries that purchase Russian crude.
Yeah, anytime that we're looking at geopolitical events, we always ask the question, will it affect earnings? If the answer is no, it's something that should be faded because it likely is just a near-term hit to sentiment. If the answer is yes, it's likely because of oil prices. And so as we look at the dynamics around oil prices, you're sitting with a daily average gasoline price right now sub $3. And you've been in an environment where the last 3 years you've had consistent year-over-year decline in oil prices. For the U.S. consumer, that's effectively a tax cut. So if you were in a scenario, whether something happens with Russia or within Venezuela, that you see gasoline prices and oil prices change direction, that could be a very interesting wrench for the U.S. consumer as well as for the Fed.
And not only that, but also companies, as it's a main input product.
Yeah, most definitely. And you think about something like Venezuela, where they produce heavy sour crude, which is used in diesel. A lot of talk of how diesel markets are already very tight. So if you think of the industrial implications, if you were to have a conflict like that, you could see diesel prices move higher. But again, you're not in an environment where oil markets are especially tight. You have the Strategic Petroleum Reserve that's still well down from its 2021 peak, but has been building. So in theory, there would be room to absorb a little bit of a cushion if you saw oil prices inch up.
So what I'm hearing from you is that although these talks might be important, the market is just going to shrug them off.
Yeah, that is typically the case with any geopolitical event. It really comes down to this notion of, yes, it might be scary, yes, it might be bad for certain populations, but if it doesn't impact U.S. corporate earnings, it's something that should be faded.
At the same time, I mean, if you just take a step back, this year was all supposed to be about the real physical world, and we've seen the revenge of the physical world since the pandemic, and that after the conflict was over, and hopefully that will be soon, there would be a rebuild effort in Ukraine. There would be infrastructure that would have to come in addition to the build out of infrastructure for AI in Europe. I just wonder how people are understanding the pricing of that story, given the fact that that has been known. But there was reports today that Europe is struggling to get some of the natural resources that they're looking for because of the stiff competition from places like the United States.
Yeah, maybe there is some of this perkiness that we're seeing in those industrial metals starting to show up as some of this rebuild. And I think at the end of the day, there's still questions about how much Germany would be willing to do as far as expanding its fiscal deficit and really holding to that black zero of balanced budget. So, I think that hope springs eternal that you're going to see this big, huge infrastructure build out. It always seems like we're perpetually next week is infrastructure week, and that just simply hasn't materialized.
Which is the reason why I think a lot of people are trying to understand just how different this administration is with respect to a more transactional approach to international policy, how much you follow that versus just simply go with the sort of mainstay of ignore geopolitics unless it affects the price of oil.
Yeah, and certainly there's been so much more focus on internal things within the U.S. and receding from some of these geopolitics to focus on things like bringing manufacturing back to the U.S. and being able to make sure that you have access to key inputs like rare earth materials. And we are starting to see some progress in the ability to build out that kind of infrastructure, but it certainly takes time.
Yeah, well, this is definitely what everyone keeps talking about, which is essentially this is a very long-dated issue. Cameron Dawson's going to be sticking with us, but to me, this is sort of the key question. If this really is the revenge of the physical world, is there a mismatch in the disinflation that AI will create with the inflation potentially of the real world materials that are needed to really make this happen?
Well, you might get the inflation first and the disinflation comes later. Talking about the physical world, though, David Sachs in the last 48 hours was tweeting about this Wall Street Journal article about how actually the cost of construction workers, plumbers, welders have all gone up. But this is sector specific and region specific based on whether or not a Microsoft is investing billions of dollars to build an AI plant in your district.
That was a great story, by the way, about the arms race to hire people who are able to construct some of the data centers and the ability to make $200,000, $250,000 a year. But you're right. This is something very sector specific, focused on those data centers.
Absolutely. And it's going to take, you don't build a data center overnight. This is going to take years and years of a build out across the United States.
Coming up, we're going to be talking about inflation of a different type, the bill that you pay for your cable network. Bloomberg's Geetha Raghunathan as media giants race to acquire Warner Brothers Discovery. Plus, Danny Berger with your morning movers, MongoDB soaring on an earnings beat. Otherwise, pretty quiet right now, although you are seeing a rally build steam led by, guess what, big tech. This is Bloomberg Surveillance. building on a rally, trying to melt up into year-end. Tech stocks, which have been beaten up and underperforming in a significant way, outperforming this morning. What you do see is those gains continuing to build up 0.3% on the S&P. Nasdaq futures up 0.4%. The Russell 2000 up 0.6%. A real question about what's going on in the bond space. Yesterday, we started off with a little bit of a sell-off, even with the Bank of Japan indicating they probably were going to hike rates later this month. And then as the session grew older, those yields continued to climb, building on that increase this morning. 2 years up just slightly, but 3.53%. Yesterday, it was led by the long end. We really saw that 10-year yields continuing to inflect higher, almost at 4.10. Cameron, what did you make of what we saw yesterday? Was it that people were waking up to the idea of the Bank of Japan, or was this something else?
I think that it was partially Bank of Japan, that if they were going to be more hawkish incrementally at the margin, you have less treasury demand. But I do think a lot of it was the Costco story. It was the idea that potentially that if tariffs are ruled illegal, that they'd have to give the money back, and that Costco suing to try to get the money back would suggest that you would have a bigger hole in the budget, meaning that all of those billions of dollars raised by tariffs would now have to be funded by treasury issuance. And given the fact that you have things like the reverse repo market being much smaller, that balance could push issuance on the long end of the curve, thus higher yields in the 10-year.
We're going to get into that story in just a minute. Great tease. Right now you are seeing Bitcoin not necessarily seeing the plunge that it saw yesterday, where it was plunging almost 9% at one point. The most is going back to March. Today, just a little bit of a breather. We're not going to be covering Bitcoin in mass, but it really is a tell of just what the risk sentiment is and what kind of pain is out there in the retail space. 3 hours away from the cash open. Here are your morning movers with Danny Berger. Danny.
Hey, Lisa, feel for the bankers who over the Thanksgiving weekend had to do work on this. Warner Brothers Discovery fielding second rounds of offers for it. That includes an all-cash, reportedly mostly cash bid from Netflix. So those shares are moving higher by 1.76%. Reportedly, Warner Brothers Discovery is aiming for $30 a share for the bid price. The chair emeritus at the company believes that they will be able to do so. A little bit of earnings to get through. MongoDB, this is the cloud software company, a raise to their outlook, a new CEO at the helm, saying that it is their AI powering of different applications that really helped their results, be it from startups, more established companies. Those shares up 24, just under 24%. Finally, a little bit of deal news. Marvel Technologies are going to have their earnings after the bell, but the information reporting that they will be buying a company called Celestial AI. This is an AI company that basically powers the applications through light, through photons versus electronics. Apparently, that makes things more seamless. Multiple millions is the price tag that the information reported. It is an unprofitable company. Nonetheless, a lot of AI M&A happening just in general. So those shares moving higher, Lisa.
Thank you so much, Danny. On our radar this morning, a real focus in Washington, D.C. President Donald Trump set to host a cabinet meeting later today. Top officials will likely continue outlining next steps amid mounting tensions with Venezuela. The real question may be, how much is this really going to continue to swirl over the head of Pete Hegseth, the head of the Department of War? How much is that in sort of the ether in Washington, D.C.?
Absolutely, because you're seeing bipartisanship across Congress when it comes to individuals that serve on, say, the Armed Services Committee that want answers to what actually went down when it comes to the strike on that boat when there was 2 survivors. There was a Washington Post report that Pete Hegseth, the defense secretary, had this call to say there should be no survivors, everyone should be killed. And then a second strike was ordered by this admiral. And it seems to be a distinction without a difference. If it comes from the top, doesn't that come from Pete Hegseth? So that's kind of been the back and forth. But the White House Caroline Leavitt has come out and really defended what the Defense Department did, but potentially this can have repercussions in Congress.
Which is the reason why people are watching this cabinet meeting very closely. Elsewhere, and this is something that Cameron was talking about, and we'll dig into now a little bit more. Costco suing the Trump administration, the retail giant joining dozens of companies seeking to guarantee tariff refunds if the Supreme Court rules the president's global duties unlawful. Cameron, you were saying that you think this is part of the bond market sell-off yesterday because it really plays into the fiscal story. Does this increase the potential deficit of the United States should there be repercussions from the Supreme Court ruling?
Yeah, part of the reason why we think that the bond market has been so calm over the course of the last 6 months or so is because you have had this tariff revenue that has allowed them to not have to issue as many treasuries. So if that gets called into question and and you have the potential that some of the money would have to be given back if some of these lawsuits are successful, then it would suggest that you have more Treasury issuance and thus upward pressure on curves.
Costco is basically filing the suit saying that IEEPA is unlawful because they feel like even if the Supreme Court comes down and says that they are unlawful, they will not be for sure green-lighted to get those refunds back. So they are getting all their ducks in the row, preparing potentially for the Supreme Court to come down on them. They have collected $2 billion at minimum already this year. They say they could potentially bring in trillions, at least the tariff policy, over the next decades. If this does not stand up, this is going to complicate the Trump administration ahead of the midterm elections because they're going to have to basically redo the entire trade policy using many other legal authorities, but just take a lot more time.
I wonder also with a big player like Costco doing this, whether it greenlights it for other companies as well, to say it is okay for you to get on board and line up to get all of your ducks in a row, to your point,
They're going to have to file a suit then and say it's unlawful. So that's going to put them at crosshairs with the administration.
Well, this is exactly the point. Meanwhile, another sharp drop in the crypto market leading to the liquidation of almost $1 billion in leveraged trading bets. Bitcoin sliding as much as 8% yesterday, bringing its decline since early October to almost 30%. Cameron, do you watch Bitcoin every day?
Well, it's important as a gauge for liquidity as well as risk appetite. And the fact that Bitcoin wasn't making new highs as other parts of the market were was making us uncomfortable over the course of the last couple of months. Because if liquidity is tightening, if risk appetite is waning, it means that that low quality speculative leadership that has really dragged this market higher since the April lows should be in question.
Which is the reason why we're following it this morning. If you're wondering whether we've turned into a Bitcoin channel, it is not that, but it is a really important kind of view on liquidity. Let's turn to media. Warner Brothers Discovery fielding offers for media giants as sources say the auction could wrap up in the coming days. Netflix making a mostly cash offer as Paramount and Comcast do still remain in the mix. Geetha Ranganathan of Bloomberg Intelligence joins us now. Geetha, Netflix, almost all cash, and yet there still are other players in the mix. How close are we to some sort of conclusion to this ongoing melodrama?
Yeah, thanks, Lisa. So this was the second round. It's not necessarily the final round of bids just yet, but the offers are binding. So if the board decides that, they do see an offer that they like, this might very well be, we might be very well close to a conclusion of this ongoing M&A saga for Warner Brothers Discovery.
Geetha, any sense on where they are leaning right now?
So what was really interesting about the Netflix offer, first of all, I don't think anybody on the street really initially thought that Netflix was making a very serious offer here or that they were seriously interested in Warner Brothers Discovery. Warner Brothers Discovery has been seen more as kind of an existential asset purchase for both Paramount and Comcast, not necessarily for Netflix. So first of all, the fact that they've come so far, they're in the second round. And the fact that they're making an all-cash offer, I mean, you have Netflix stock is extremely valuable when compared to either Comcast or Paramount Skydance. So I think, we're seeing a little bit of, I think, a change here in sentiment. I mean, we would have expected more news maybe from Comcast, a sweetened offer. There have been some reports, but I think Netflix is really serious. So I think that's a little bit of a change that I don't think many people had seen coming.
Besides the cash offer, and besides basically the financial offer, is there anything that Netflix is offering that makes this more attractive than the others?
So I think with Netflix, there have been some reporting suggesting that, the regulatory aspect is going to be a little bit of a concern. You do have Netflix, which has close to maybe about 325 million streamers. You have HBO Max, which has about 130 million. You put those two together, you obviously have a streaming service, with a huge moat with over 450 million streamers. So that's obviously going to be a little bit of a concern from a regulatory standpoint. Now, Netflix themselves have, the big question for Netflix has obviously been, they've always been against releasing movies in theaters. So the fact that they're buying Warner's studio assets, which is obviously one of the biggest studios in Hollywood, the big question has been, will they, pull all those movies? Will they continue to release those movies? And of course, Ted Sarandos, who's the CEO, has kind of assuaged theater owners and, the Hollywood moguls that they will continue to release those theaters. So they're doing everything that they can, I think, from a regulatory front, just to kind of appease and assuage, the the regulators, but still it's kind of a wait and watch here.
Bloomberg's Keith Raghunathan, thank you so much for that. Cameron, are you actually investing in any of this stuff? Are you betting on the consolidation of the media space?
Well, I think it's actually interesting how this will all be funded, because it's looking like it would be a $60 billion deal. And if you look at the amount of cash that Netflix has on its balance sheet, it's about $9 billion. So they're going to have to raise debt. They don't have a lot of debt in their balance sheet. They have 0.6 net debt to EBITDA. So there's room for them to do that. But if they go through this deal and it is a cash deal, they will be going to the debt markets.
A very smart take, and very much increasingly the take when it comes to a lot of the dominant corporate stories, certainly in the tech space with OpenAI and all of its debt issue. And speaking of that, OpenAI CEO Sam Altman declaring code red. According to a memo seen by multiple outlets, Altman sent a company-wide message stressing the need to improve ChatGPT as Google gains ground. Bloomberg's Tom McKenzie joins us now. Tom, we've seen a slew of memos reported on from Sam Altman talking about increasing concern about the competition from Google in particular. How much are they taking this seriously? How much are they innovating in a way where they could keep an edge versus some of their better funded peers?
And it does, Lisa, speak to that funding story that you just touched on there, the need to have those deals, the need to raise capital, have that liquidity and raise debt as well for OpenAI, which does not have the balance sheet, of course, of the likes of Alphabet, and needs that liquidity and that funding to spend not just on the infrastructure, but to ensure that there is adoption of their products, and particularly GPT. So yes, they are taking this very seriously. To your point, there was a memo put out on Monday, according to the information, on this red alert that Sam Altman is now issuing across the company, because Gemini is now so good. Gemini 3.0, it's been incredibly well received within the developer community, within the AI ecosystem, and the uptake is there. Google is also able to embed its own models into its products, get it into the hands of users very quickly, and it's proving effective. And they are seeing the user growth, just as the user growth, it seems, for OpenAI is starting to slow. So that race between, if you have 4 or 5 horses that are out front, then, of course, Sam Altman, OpenAI, was straight out of the gates. November 2022, Gemini was on the back foot, Google was on the back foot. They had their own red alert. Now they are very rapidly catching up. And that is where the emphasis is now. That is where the concern is. So it seems like Sam Altman is telling the business, telling OpenAI and the team to focus front and center on their GPT models. And they say there's going to be an update potentially next week to rival Gemini 3.0, and to walk back maybe from some of their their efforts around advertising, maybe for some of their agentic push as well, because they need to get the primary product right, and they need to make sure they're not losing that customer, the growth that they've seen, that they think could lead to revenues of $10 billion this year, possibly $20 billion next year, and possibly $30 billion the next year on 2027. That's all dependent on the continuing growth and uptick amongst individuals and corporate consumers as well.
Bloomberg's Tom McKenzie, thank you so much for that sort of expected growth in revenues, part of the issue. I mean, Cameron, that is part of the problem, given how much their debt pile has surged, and the leverage tied to it, not just from them, but also data center providers, has grown to something like $100 billion.
Yeah, and this blank check that you've had investors be willing to write to companies in order to be in this arms race, now it seems to be that there's much more of a question of what will the return be. And we still come back to the fact that AI is just so much more competitive than their legacy businesses, which were near monopolies.
Yesterday, also, we heard about OpenAI taking an ownership stake in Thrive Holdings, which basically is Thrive Capital, which originally invested in OpenAI. Yeah. Once again, another episode of circular financing. At some point, does that really start to freak people out?
Yes, and what we find is that circular financing is really good on the way up. It actually adds to the capability of growth because you're having this kind of circular self-reinforcing kind of dynamic. The problem is that once something turns, once the catalyst happens that causes it to turn, it magnifies things on the way down. It's Andrew Lowe's adaptive market hypothesis in full force.
Yeah, and this really goes to also NVIDIA with Synopsys yesterday, this idea of vendor financing, all making people a little bit nervous. It also suggests they just have so much cash, they don't know what to do with it. So I guess that's the better outlook, at least on the story. Right now, let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. White House Special Envoy Steve Witkoff is in Moscow today. He's meeting with Russian President Vladimir Putin to discuss the latest proposal to end the war with Ukraine. Ahead of the meeting, Putin said Russian troops took over the city of Pokrovsk in Ukraine's eastern Donetsk region, but Ukraine's military spokesman denied the claim. Meanwhile, Starbucks has agreed to pay $38.9 million in a settlement with the city of New York. The coffee chain was accused more than 500,000 times over a 3-year period of violating a local law requiring fast food businesses to give workers predictable and stable schedules. Starbucks has to pay $35.5 million to more than 15,000 workers. And Amazon is testing a new ultra-fast delivery service. The online retailer is aiming to deliver groceries and other daily essentials in 30 minutes or less to customers in major U.S. cities. The company is seeking approvals to build or renovate small delivery hubs in cities, including Seattle, Philadelphia, and Fort Worth, Texas. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, airlines taking a hit. Do you think there's going to be any permanent hit to the fourth quarter earnings because of the shutdown?
You can't make up a 1 week of Delta. We had a little over 2,000 cancellations. You can't make that up within the quarter.
Tom Fitzgerald of TD Cowen joining next. This is Bloomberg Surveillance. Building on a bit of a rally, at least a reprieve from yesterday's losses. You're seeing across the board up about 0.3% on the S&P futures. You are seeing yields inflect a little bit higher, building on some of the losses from yesterday. 10-year yields 4.09%, and a little bit of just stagnation everywhere else. Not a very active day. 116 on the euro-dollar cross. Under surveillance this morning, airlines taking a hit. Do you think there's going to be any permanent hit to the fourth quarter earnings because of the shutdown?
You can't make up a 1 week of Delta. We had a little over 2,000 cancellations. You can't make that up within the quarter. So yes, there was an impact like there's going to be in all the airlines. It's transitory.
Here's the latest. Major airlines under pressure heading into year-end, facing a range of issues from the fallout of the government shutdown to problems with Airbus aircraft. Tom Fitzgerald of TD Cowen lowering his estimates on the big 6 U.S. airlines for the fourth quarter, but still seeing positivity ahead, saying as long as the broader macro economy can continue to grow in 2026, the sector should see a better year. Tom joins us now for more. Tom, can you just talk about what went into your downgrade for the overall estimates of the airlines and whether you think that it could really set them back in a more protracted way?
Thanks so much. It was predominantly driven by the government shutdown. We saw a pretty steep impact on the first half of November, especially for corporate traffic, which was very hot in October, and Thanksgiving data looked a little bit softer than we were expecting. So it was most of our estimate revisions were due to that, and then we took it down a little bit further out of caution ahead of the December holiday period. But overall, we think this is an event the market will look through. We think most investors are expecting guidance cuts this week and next week, and we think it should be a clearing event for the group.
Could any of the airlines make up for what happened with the shutdown?
I don't think so. I think there's like a certain element of demand that just got destroyed. It's possible some bookings were pushed off, but I think there's a lot of trips that just didn't happen, and it's unfortunate.
So what are you looking at for 2026 when it comes to the airlines? Who do you think is going to lead the pack, who's making the right decisions now, who maybe made the right decisions when it comes to cost savings during the government shutdown?
United's our best idea for 2026, and we think they've been making the right decisions for close to a decade now. You go back to the pandemic when they decided not to retire their wide-body fleets. They kept their pilots in place so they were able to rebound faster than people. Their fleet renewal plan drives a really attractive flywheel where they take in larger aircraft than the planes they're replacing, so they don't spill as much revenue. They have more premium seating and more basic economy seating, so that's a bit of a category killer. And because the planes are larger than the ones they're replacing, there's a really nice non-fuel cost tailwind as well. So we think they're probably they're the highest quality growth story among the U.S. airlines as we go into next year.
Tom, how much are the airlines the perfect synopsis of the K-shaped economy, and how the airlines like United and Delta will continue to get business and continue to expand their lead over the other airlines as better heeled customers are able to shell out a bit more?
I think you've said it well, and I think it really ties into how important revenue diversification is and how much more resilient the earnings of those two companies are versus the broader peer group. If you look at how estimate revisions for full year 2025 EPS have trended over the course of the last year. All the airlines saw their numbers cut, just given the events of this year. But Delta and United, it was, estimates came down about 16-20% versus the other airlines. It was more in the, 30 to 60% range. So I think these two are in a league of their own.
Tom Fitzgerald of TD Cowen, thank you so much. Still with us is Cameron Dawson of NewEdge Wealth. And I am curious what you're looking at to try to get a gauge of the consumer. We were talking about airlines. We do get some vehicle sales today. We're going to be getting ISM services come tomorrow. We're going to be getting ADP data. We're not getting non-farm payrolls. We're trying not to pout about that. But I'm just wondering what your compass is as you gauge whether people will keep spending.
We think the most important compass is the equity market itself. We've been looking at the ratio of equal weight discretionary versus staples and arguing that as long as that ratio remains in an uptrend, this is an equity market that says that the aggregate consumer deserves the benefit of the doubt. But as we know, as you mentioned, the K-shaped economy, that the aggregate consumer does not reflect the average consumer, meaning that the largest consumers are the strongest, so they're making the overall data look better. However, the smaller consumers, which are weak, is what's really being reflected in things like sentiment data, which is why you can see something like University of Michigan Conference Board data looks so weak because every vote counts the same. But when it comes to spending, it's market weighted.
We haven't even mentioned the Fed this hour. You're welcome. But I am wondering how much it would really change the dynamic if you did get Fed rate cuts later this month, next week, as well as several next year.
So this is where I think there could be a big plot twist, which is that the high income consumer actually loves higher rates. They have termed out mortgages. They have big cash balances. And if you go back to the last few years, what you actually saw was interest income growing rather rapidly, up to a peak of 20% back in 2023 because the Fed was raising rates. So we actually think that rate cuts hurt the high-income consumer more than they help the high-income consumer because they don't have nearly as much reliance on floating rate debt.
Which is going to be something that the administration will try to deal with, I'm sure, if they get what they want. Cameron Dawson of NewEdge Wealth, thank you so much for being with us for this entire hour. Wonderful to get your thoughts, as always. I mean, it's clear that this is what's partly on the minds of people in Washington, D.C., especially as there's another meeting today with potential redress of some of the cost of living issues.
Absolutely. Affordability has been top of concerns for Americans. It continues to show up in polls. The president continues to remind Americans that gas prices are lower, but other items are higher. Coffee, bananas, avocados, which is why you saw the administration make a U-turn when it comes to some imported agricultural goods and food products, because they are trying to address the affordability concerns, because it continues to show up in polls. But also, Cameron is talking about how maybe the high-end consumer actually wants higher interest rates. The low-end consumer does not want that. And this administration has been constantly talking about delivering for Main Street. Well, for them, that means, in their view, the Federal Reserve needs to continue cutting interest rates.
I wonder if anyone's done a study about how much lower prices of bananas would really help the price of inflation, because bananas are not the most expensive fruit. It really is blackberries. I'm just saying, if they want to really reduce CPI, we're not going to get into that. Coming up next, we have a wonderful guest. Apollo Global Management President Jim Zelter will be joining us. Wei Li of BlackRock with a new outlook, and Cristiani of JP Morgan Private Bank with a huge focus on Latin America, with Venezuela very much in the forefront. Right now, you are seeing maybe some sort of reprieve in terms of risk appetite, with stocks rising ahead of the open. This is Bloomberg Surveillance.
The underlying question is what the market expect the Fed to do versus what the Fed should do.
They're back in the game with more rate cuts.
This should be a mixed decision right now, and they might err on the side of cutting.
We think they will cut at the meeting next week, and our sense is that they could cut again in January.
This cut is going to happen. I think the data will prove them wrong as we head into 2026.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Looking for the Santa rally after a rough start to December, with traders building on earlier optimism, at least this session, although fading just a touch. Look, we're trying to make something with this after yesterday was a significant sell-off. But right now, at least, for the time being, and not necessarily focusing on stagflationary headwinds or overvalued AI companies, still questions are lingering about the AI race's leadership, with OpenAI's Sam Altman calling for a code red in the race to chatbot supremacy, with Alphabet's Gemini seeming to gain some ground.
So Google had their own code red moment because of what ChatGPT was doing in OpenAI, and now OpenAI is looking at, oh my God, Gemini has taken off. It's a resurgence. We need to double down and work on our product. And it comes at a time when they have committed hundreds to billions of dollars when it comes to the infrastructure and data centers, which is why there is cause for concern. But it was always going to be this way. Cameron Dawson is talking about that. And she actually likes what she's seeing in the space because it shows that it is competitive and it actually is an AI race. The problem is, who is going to win when you have billions of dollars being committed? And as we talked about the last hour, a lot of these deals are very circular in nature. So if someone goes bust, potentially a lot of companies will be going bust.
We have a lot of time to focus on this because we're not focusing on non-farm payrolls, which we are not getting on Friday, and we're not getting JOLTS data, and we're not going to be getting a whole host of other potential data points. What we are getting this week is ISM services, which is going to be really important coming up tomorrow, given what we saw with a sort of stagflationary tilt under ISM manufacturing and then ADP jobs and jobless claims. Coming up this hour, let's get right to it, because to me, this really is the conversation of the day. Apollo President Jim Zelter, with investors remaining skittish to start the month, still looking ahead to a brighter 2026. Wei Li of BlackRock, with AI transforming global markets, and Cristiani of JP Morgan Private Bank, as the U.S. increases pressure on Venezuela. We begin this hour with investors trying to claw their way out of recent worries about overvalued tech companies, stagflation. Apollo Global Management President Jim Zelter joins us now. Jim, wonderful to see you. Thank you so much for being here.
Always nice to be here, Lisa.
So let's start with the look ahead for next year, which is everything is awesome. And what we're hearing from every single person who comes on the show is that next year is going to be double-digit gains in the S&P 500 at the same time that you continue to grind out better returns from the debt space. Is there a contradiction here?
Well, I would just say that the confidence sitting here in December about next year that anybody puts forth has to be taken with a little bit of skepticism because of the year we've just had. If you were here on this journey this year, obviously it's been a tremendous amount of volatility, and we've ended up in a place that many probably wouldn't have predicted. But as we sit here right now thinking about the year ahead, you're going to end this year with an extremely strong M&A calendar and M&A backlog in terms of what's actually been executed this year, but also in the pipeline of new deals. The expectations on the Bloomberg economics page is a 30% chance of a recession next year, a little bit higher inflation, a little bit lower growth. And as we talked about a moment ago, one of the markets has to be wrong. In this intersection right now where many are saying we need to lower rates because of an economic slowdown, and the other side saying earnings upside because of accelerating earnings from the Mag 7 and the 493, those both can't be correct, or it's very, very unlikely that they'll both be correct. We're in the camp at Apollo, as Torsten's been up here and many others, that between the K-shaped economy and other demographic issues, we're going to probably see a deceleration of lower rates and a stronger economy in terms of M&A, CapEx cycle, positive regulatory backdrop, and things of that nature.
So if bonds and stocks can't both be right, and they seem to be in conflict right now, are you saying that stocks have it right and bonds have it wrong?
I'm saying what's been surprising to all of it, if we take a big step back the last 4 or 5 years, the idea that the Fed would raise rates so much that they did, starting in 22, we all predicted massive slowdown in the U.S. economy, tightening financial conditions, and we were all wrong. This U.S. economy has been amazingly resilient. Now, it's been resilient for organic reasons as well as a lot of fiscal spending, obviously now the CapEx cycle, but the U.S. economy has been the most resilient for a variety of reasons, and our suspicion is that will tend to continue in the year ahead. So I think if you look at the gap in the last month or so of the Mag 7 earnings growth and the 493, a year ago it was like 30-35%. The growth rates of the Mag 7 and the 493 in the last quarter was 11%, 22 versus 11, I believe. So the rest of the U.S. economy is doing somewhat better in light of the breadth of the AI cycle.
But how much is this really all predicated on the ongoing funding of the AI cycle? I mean, this is sort of the fear that you're seeing baked into markets right now, is that there's a lot of debt coming into the space and everything is leveraged to AI being the solution to absolutely every problem that we have.
Well, I think you need to separate that a little bit. On the equity side of the AI activity, and Annmarie mentioned it at the start, certainly you've got the incumbents that have amazing business models, whether that's Alphabet, Meta, and the other Microsoft and Amazon. And then you've got the upstart, OpenAI. They're all coming from a different situation. The 4 or 5 have incredibly strong balance sheets and incredibly strong CapEx and free cash flow, which they're going to allocate to the AI equity story, because for them it's an existential issue. So for that's the equity side of the equation. What you're really touching on is this question of the 5 to 7 trillion that's expected to be needed to fund the data center and infrastructure capex of the next 5 to 7 years. That's been the zip code of the numbers being bandied around. And today, if you look at that number in aggregate and take a step back again, as the industry of that 5 trillion, about $1.5 trillion will get funded from free cash flow of the hyperscalers. The next $1.5 trillion will get funded between project finance, private capital, and a variety of other debt markets. About $1 trillion, $1.25 trillion will get done by the high-grade investment grade market. So it leaves about $1 trillion, $1.5 trillion. Where is that going to get financed? That's a question mark. What's the clearing price of that paper? And so, we spend a lot of time thinking about that. Those are the big picture moves that will really have an impact on pricing of the IG market, pricing of the high yield market, pricing of investment grade private credit. That's the big question that we're all grappling with if you're in these markets today.
Last time you were on, you talked about how financing these data centers is fundamentally different than in the past financing other technology projects. Why? Why are they so different?
Well, the last 30 years in the U.S. high yield and leveraged finance market, for the most part, you've been financing companies that were disruptors, but they were not investment grade disruptors. Think of the cable companies, think of healthcare companies, think of gaming, even companies like MCI and the regional airlines. This time, with the hyperscalers, again, if you look at the balance sheets of Microsoft and Google and Amazon, these are some of the greatest companies we've ever seen. $300-400 billion in revenues, $150 billion a year per company in free cash flow. So there is a counterparty to those businesses. You're willing to take on much longer duration risk if they are the tenant counterparty than you might have been at an upstart MCI or an upstart airline. It's just a very different economic equation. It's great investment grade risk. It's challenging non-investment grade risk. Now, the impact of that, if you look at the investment grade market today, which is about 11 trillion, it's up from about 3 trillion 10 years ago. That's really dominated by the financial services companies. The biggest issuers are JP Morgan, B of A, Wells, Morgan Stanley. The top 7 are all banks. If the predictions about the AI data center boom are correct, and the capital needs of the 5 trillion that I just mentioned will come through, you're going to look at the IG marketplace in the next 5 years. The top 10 will be very different. It will have Meta, it will have Amazon, it will have Microsoft, if they do pursue that path of funding, which is it's one of the largest, deepest markets, 11 trillion, they're going to have to access that. So when we step back and think about the next 3 to 5 years, we think about how the investment grade public market is going to change in context and risk. It's one thing financing some of the great financial services and banks in the world. Post-GFC, our banks and our financial services companies are the strongest, healthiest in the world. You don't mind being a debt lender to those. These other companies, they're taking business models that have been amazing business models, that have been asset-light business models, that have generated tremendous amounts of cash flow, and they're just changing the risk of being a lender to those companies. It's not bad risk, it's just different risk.
It sounds like this year was the year of credit. We were talking about how the 2025 banner year was credit. It sounds like next year isn't going to be. It sounds like next year the investment is in something that is more revenue stream based, that is maybe more equity driven, that isn't as leveraged to the story that you're talking about, which is an increasing glut of issuance, potential sticky inflation, and a Fed that's not that accommodative.
I actually take the other side of that. I think it's actually a tremendous time to be in credit.
There we go.
I think this is all about dispersion. It's picking the right names from the wrong names. It's about, like, people in credit are focused on credit, whether it's IG, public, high yield, private, and it's the dispersion that we've been waiting. If you're a 40-year veteran of this business and have built a massive credit platform, we like dispersion. We like being in the middle of trying to pick the winners and losers, because at the end of the day, that's just good credit picking. And I do think you're getting rewarded with base rates between 3 and 4%. And the clearing price for a lot of this CapEx for these data centers going to be more challenging. That's when you can actually earn your keep by being a smart investor.
Do you think we're heading into a distress cycle?
I don't see it. Listen, we are one of the largest historical players in the distressed arena. If you look at the numbers in the last 12 months in the loan market and the high yield market, they've actually come down in terms of the default rates. They were a little bit north of 3-4%. They've actually declined. So on a $3 trillion plus high yield and loan market, defaults of 2.5-3%, that's 60 to 90 billion. I don't see an overwhelming amount. Now, what I do see is I think you're going to get more secular distressed than cyclical distressed. And that's very important. When we think about secular distressed, I think that the development of AI will change broad business models. If we've talked a lot about healthcare technology, we've talked a lot about, the outsourcing businesses, we've talked about software, enterprise software. The AI impact can have dramatic impact on those business models. And typically, when you go back in the underwriting memo and you think about your base case and your downside being down 5, 10, 15%, when you have secular dislocation, you've missed the downside by multiples. And that's what you're probably going to have. But again, I think it's a great question, because I think a lot of the topics that are being discussed right now about the role of banks in private credit or the transparency of private credit, they're legitimate questions, but the bigger questions are, it's been a long time since we've had a credit cycle. We're gonna have a credit cycle. That's normal, it's natural, it's a cleansing process of capitalism. And again, I think that when you have a business like we've been in, where you have many companies that are more upstarts, we've been doing this, I've been doing it for 40 years, we've been doing it at Apollo for 35 years. I feel comfortable about our ability, but you've got some tourists in this space, no doubt about it.
Tourists, we'll get into who those tourists might be. He's not going to say. But we'll be, Jim Zelter of Apollo will be sticking with us, and we'll be continuing this conversation. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Anand.
Hi, Lisa. Airbus is inspecting hundreds of its A320 jets for potential quality flaws in the plane's body. According to materials from a presentation seen by Bloomberg, a total of 628 jets contain panels that may be either too thick or too thin due to a manufacturing issue with the supplier. Of these, 168 planes are already in service with carriers, and the rest are at various stages of production. Meanwhile, Big Short investor Michael Burry is betting against Tesla. Fortune reporting that Burry, best known for betting against the housing market during the 2008 financial crisis, says Tesla is ridiculously overvalued. He is also warning that founder Elon Musk's proposed $1 trillion pay package would worsen shareholder dilution. And the Northeast is preparing for its first major snowstorm of the season. Some parts of northern New England could see as much as 10 inches of snow. The storm could also drop up to 4 inches of snow in Chicago, where a record 8.4 inches fell at O'Hare International Airport on Saturday. That's Bloomberg Brief. Lisa.
Thank you so much, Yahira. I think that we're just going to get rain here in New York City. Is that right?
That's what I've heard.
Okay.
Except upstate New York has already, like Saratoga, Albany, they've already gotten some snow.
Yeah, I know. Make reservations.
Yeah, upstate is Rochester, New York. That's
come on.
That's upstate New York. Albany's not upstate.
Come on. It is kind of
anything north of Westchester is upstate.
We'll be discussing not that. Up next, President Trump's tariff agenda.
Our view is that if the Supreme Court does strike down the IEEPA tariffs, that the administration has been pretty clear that they have other tools in their toolkit.
We'll continue the conversation with Apollo President Jim Zelter coming up next. This is Bloomberg Surveillance. Seeing a bit of a reprieve from yesterday's risk-off feel, but just fading as the morning goes on. Not exactly a massive rebound from yesterday's declines, up 0.2% for S&P futures. Meanwhile, it is a quiet morning out there. Not seeing a lot of action on the currency space. Yields, though, creeping higher on the long end. Keep watching this space based on what we saw from the Bank of Japan yesterday, leading into 10-year yields rising by 7 basis points today, building on that higher by 2 basis points to 410. Under surveillance this morning, President Trump's tariff agenda.
Our view is that if the Supreme Court does strike down the IEEPA tariffs, that the administration has been pretty clear that they have other tools in their toolkit, such as sector-specific tariffs. So our view is basically that tariffs in this regime are likely to remain in place in some form.
Here's the latest. Costco joining dozens of companies suing the Trump administration to ensure eligibility for refunds if the Supreme Court strikes down the president's sweeping global tariffs. Joining us now is Bloomberg's Mika Solner in Washington. Mika, welcome back. I am wondering how much this is laying the groundwork on Costco's part to get refunds from the federal government, and whether this is building on what we're seeing from other corporate leaders around the United States.
Yeah, well, this is another issue that the White House is going to have to deal with, and it does increase pressure on them when it comes to Trump's posturing on tariffs, which has caused a headache for major retailers like Costco, which has taken steps to increase its domestic production and retailers and create more grounds that way and trying to skirt those tariffs. But I also think that it puts pressure on the White House when it comes to the issue of increased costs for consumers, as affordability and cost of living continues to be an issue for everyday Americans as well.
Mika Solner, thank you so much for that. Apollo Global Management President Jim Zelter still with us. And Jim, that question of affordability very much in the focus point, not just for the Federal Reserve, but also for the federal government. From the Fed's perspective, how much is it seeming like the logical step to cut rates in response to affordability concerns at the lower end of the consumer base?
You know, I know you've had Torsten on recently to talk about this. I do think the K-shape economy and the demographics of that, it's really having an impact on the transmission mechanism of Fed policy. I do think the last 3 to 5 years you've seen, whether it was this emergence of the K-shape economy and our demographic shift of income and wealth, along with the evolution of our banking system, the evolution of dispersion, securitization, private capital, I think that's blunted the impact on monetary policy. And so, while I understand the impact of the view that rates are a bit higher than the nominal rate right now, or the neutral rate, excuse me, I just don't see a huge, other than confidence in the equity market, I don't see a reason to cut rates dramatically. But I do think there's no doubt this affordability issue. We saw it in New York. We saw it in the national. We saw it in the various elections around the country, Virginia and other places. It's going to be a topic for this administration to deal with.
Absolutely. And we've seen them actually backtrack on some issues because of it. Torsten Slok actually published this morning talking about significant fiscal boost coming in 2026 when it comes to the one big beautiful bill. 2025, it was a lot of uncertainty. At least that's how people were viewing Washington. What do you view Washington for 2026? What's most important for you?
Well, I think that certainly it would be interesting to see what happens with the Supreme Court and the tariffs. I still think there's a lot of domestic initiatives in terms of large industrial capex. But from our perspective, this administration, when you look back at it, you really have 9 to 12 months to really get most of your activity done, and then the activity will be on the midterms next year. So I think that their ability to move in large swath domestic activities is going to be much more limited than it was this year.
So it's more of a wait and see how
I think so.
economy digests it.
Yeah,
Do you think they'll take more equity stakes?
I don't have a view on that in particular. They've had a handful. Certainly they need to deal with some of the domestic issues with regard to chip manufacturing in the U.S. A lot of the activities that were approved in the CHIPS Act with the prior administration have not been put to work. So that's an ongoing need for national security and other reasons for them to deal with. So that would be on the agenda in terms of manufacturing. But I'm not sure I see a lot of equity stakes as part of the plan.
I know you can't comment on potential live deals. There is this Paramount offer for Warner Brothers. It would be financed by Apollo, according to reporting. Do you see this environment, the regulatory environment, ripe for deals in a lot of these spaces?
You know, I think there's a reason why the M&A market will have a near record performance this year in terms of volume, north of $5 trillion. Certainly you have an administration that's much more comfortable with large industrial mergers. And certainly those larger transactions are able to garner very large financing packages. People want to invest in high quality companies, and certainly whether it's industrial consolidation or media consolidation, those types of activities garner a lot of attention and confidence.
Is there a lot going to get done between now and the end of the year, or is everyone pretty much packing it up, putting their crystal balls on and saying, look, we're going to the beach?
No, I think, listen, these are very robust markets. There's a lot of activity going on right now. The market will probably shut down in 2.5 weeks or so for a little bit of a global respite, and the predictions and the crystal balls will come out. But there's still a fair amount of activity going on, and I think the pipelines are fairly well built into the first quarter, so I would suspect a busy first quarter as well.
The crystal balls already are out, Jim. Come on, they already come out because people are looking for something to talk about. 2026 is already done and dusted. People are talking about 2027 at this point. Can you imagine?
We have to have people watch TV and sell newspapers, so it's important to all of us.
Well, thank you. It's like the big box retailers that continuously every year push Christmas up earlier. I'm seeing Christmas decorations. I saw them after Halloween. It's now like the crystal balls that Wall Street is now pushing up even earlier and earlier.
Yeah, watch the Easter Bunny start coming out. Jim Zelter, thank you so much for being with us today. Wonderful, wonderful to have you here. Really an interesting discussion as we head into next year about who's getting it wrong. I keep going back to that. This real interesting point that Jim made about the bond market and the stock market. Both of them can't be right. That you're going to have a Fed cutting rates and you're going to have potentially a real rate decline at the same time of reacceleration of corporate profits.
Reacceleration of corporate profit. Torsten Slok just talking about the fiscal impulse that we're going to get for 2026. And I think Jim was right. This year was all about the policy uncertainty in Washington, and 2026 is all going to be about the economy absorbing the decisions the Trump administration took, because really the markets were driven so much by Congress and by the White House, less so by the Fed.
Yeah, and also by AI. And coming up, we're going to be speaking with Wei Li of BlackRock on the unprecedented speed and scale of the AI build out, what that means for investing looking ahead. Plus, Yahira Anand with your morning movers. Credo technology shares soaring following an earnings beat for the second quarter. Some of these tech companies are coming out of the woodwork. I'm realizing I'm going to have to research what that company actually does. From New York City, this is Bloomberg Surveillance. Seeing a little bit of calm after yesterday's sell-off, seeing in the equity futures just a little bit of a positive lilt. You are seeing a rebound, particularly when it comes to big tech, up about 0.25% for S&P futures. You weren't seeing much else, let's just be honest. 10-year yields are continuing their grind higher. This, to me, is actually probably the space to watch, given that we saw this kind of 2 basis point increase earlier yesterday around this time. And as the session grew older, you saw that sell-off continue to mount with a 7 basis point increase in yields, priced down today 4.10 on that 10-year Treasury yield. 2 hours away from the cash open, here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We start with Credo Technology. That stock is absolutely soaring, up nearly 18% in the pre-market on what the CEO is calling its best quarter ever. That's because revenue jumped more than 270% year on year. And analysts say that was thanks to strong demand from Microsoft, Meta, and Amazon. And you ask what the company does. Well, it's a key part of the data center ecosystem, providing the technology that connects servers. Meanwhile, Instacart not having the same luck. Shares are down nearly 3% in the pre-market on worries that Amazon's new ultra-fast delivery service could cut into market share. The e-commerce giant is already hiring drivers and opening new hubs as it prepares to launch a grocery service that can deliver your groceries in 30 minutes or less, which is the same proposition that Instacart gives its customers. And we end on Bayer. Those shares over in Germany surging more than 12% in the pre-market after the Trump administration stepped in with the Solicitor General urging the Supreme Court to take up its appeal in thousands of Roundup cancer lawsuits. Analysts say that any ruling could be a win for Bayer, potentially shutting down future Roundup lawsuits and potentially lowering the cost of ongoing settlements. Lisa?
Thank you so much, Yahira. And Jim Zelter was right. I said that I didn't know what Credo was. And he said, you probably look at it and it's probably a $30 billion market cap. And guess what? It's a $30 billion market cap company that we've never heard of, which is, I guess, the story for this year.
Right, exactly. All these companies, it also feels like they're coming out of nowhere. But actually, maybe if you know, you know.
And obviously, I don't. On our radar this morning, U.S. Special Envoy Steve Witkoff meeting with Russian leader Vladimir Putin in Moscow today in an effort to end the war in Ukraine. U.S. and Ukrainian negotiators holding productive discussions on a peace deal, but with no final breakthrough. Meanwhile, the U.S. Commerce Department agreeing to invest as much as $150 million in Xlight, a chip technology startup. It's a part of an effort to create more domestic chip-making capabilities and help Xlight construct a laser prototype, and builds on this idea, Annmarie, that there is this sort of equity infusion coming from the U.S. government in a key number of potential companies.
Yeah, state capitalism in a way when it comes to what they view as national security concerns. They think that potentially this startup has the capability in the future to rival the likes of ASML. And what's interesting is the former Intel CEO, and Intel, of course, is another company that this administration took an equity stake of, Pat Gelsinger. Well, he is part of this. He is part of the chair of this company. So it has to do all with this chip space. And I think it just foreshadows more deals like this are to come. They are going to find more of these companies to get involved in.
Have we actually seen the outlines of what this sovereign wealth fund is that essentially is taking place in real time?
No, because they say that's not what this is about. But it sort of is what this is about.
You just wonder, how does it sort of have an accounting balance sheet? How do we see what it is? Do we have an understanding? Anyway, OpenAI CEO Sam Altman reportedly declaring a code red effort to improve the quality of ChatGPT. Multiple outlets reporting Altman wants to improve the chatbot's personalization features, speed, and reliability. The code red effort will delay other products. But I want to stick on tech for a minute because investors are focusing on the global market transformation with the extraordinary speed and scale of the AI expansion continuing. BlackRock remaining pro-risk in its 2026 global outlook, noting capital spending ambitions tied to the AI build-out are so large that micro is macro. I love that. Wei Li of BlackRock joins us now for more. Micro is macro because the AI story is the macro story that we're talking about. And Credo, which I had never heard of until this morning, is actually centered to a lot of the data center connectivity. So how are you seeing the transformation of this AI story in 2026 and how to play it amid a really competitive landscape?
It is very complex. So our outlook is titled Pushing Limits, and it is about making sense of large numbers. What do you need to believe to justify the spending of this amount of dollars going into AI build out, and also how to think about investing when transformations of these scales are happening around us and there is no such a thing as neutral stance anymore. So if we look at the large numbers of CapEx forecast, credible forecast takes us to $8 trillion by the end of this decade. The current forecast for big tech companies in terms of incremental revenue do not justify this amount of spending yet. But the potential of AI goes beyond existing business lines. So we're talking about AI application in non-tech sectors. So there is a path for us to get to a place where this spend can be justified. You gotta believe that we can break out of the historical growth trend of close to 2%. It has never happened before, but it is now possible. But also we need to believe that tech companies get to keep and potentially increase their revenue share, which is possible too given compute centrality. So we're talking about unprecedented spend at this moment. We got to believe in unprecedented things happening to justify, but it is possible to see that happening because of the accelerating pace of innovation that AI brings, but which is why we stay risk on heading into next year. But signposting is very, very important.
Well, I just think about risk on meaning one thing in 2025 and possibly meaning something else in 2026. Does it mean staying with the winners so far, or does it mean betting on the possible growth in other areas with a sort of broadening out in the ecosystem, the adopters, not just the generators of some of this new technology?
I think concentration first, diffusion later. We're still in the build-out phase of AI. If you look at the latest round of kind of tech correction and broader market nervousness, by the way, I'm very happy to be releasing the outlook today instead of yesterday. But there is already greater differentiation among kind of the tech performances. You have companies like Alphabet that are actually holding up well because of the TPU talk, because of the model. You have companies like Oracle coming under a bit more pressure because of negative free cash flow as well as greater indebtedness. So greater differentiation is likely here to stay, and we do believe concentration as we figure out how the revenue generated in the future are going to be split is important.
How do you identify new winners when it comes to AI?
That's a great question. So as I think about signposting for navigating the AI trade, we have to look at the financing gap of companies. We have to look at free cash flow and revenue of companies to understand if these big tech companies are still believing in each other and spending in each other. I'm talking about circular spending in terms of chips and data centers. But also we need to understand if there is, because at the end of the day, it comes down to external demand. Is this spending generating external demand? Are consumers buying and paying for AI services? Are new companies also paying for tokens? So we need to see all of this happening to kind of see the momentum going. And then the last thing I would say in terms of identifying new winners of AI is to look at the profile of revenue, because existing business lines may not justify this huge amount of spending anymore. We want to see new revenue streams being created. So we're talking about the intersection, the coming together with tech, and other sectors, for example, pharmaceuticals. And then we have to understand when new revenues are being created, who the winners are going to be, because right now it's still highly uncertain. Is it going to be the provider of compute and models, or is it going to be the provider of IP and data? And I think that is still kind of out.
In your research, you also talk about the next phase being about energy and solving for bottlenecks. Is that a 2026 story, or is that actually more 2027, 2028?
I think it is a present story, and it is a present story that goes into the future. So we actually frame the constraints facing AI build-out along the dimension of energy and physical, and financing constraint and political constraint. So the energy constraint is already happening now, and ultimately the assessment of these constraints together with the profitability of what is spent is going to determine if these companies are going to stick to their commitment, or if they may want to dial back a little bit.
Jim Zelter was on earlier this morning, and he was talking about how going forward, there seems to be a disagreement between the bond and stock market, where people in the stock market are expecting an acceleration in corporate profits. They're expecting a reacceleration in the global economy. And the bond market is looking for Fed rate cuts and just this sort of disinflationary environment. Do you see one as being right and one as being wrong in the idea of either a reacceleration with inflation or potentially a less robust backdrop with that disinflationary backdrop that people have been looking for?
I think it has been a while that stock market and bond markets may not be telling the same story. So the disconnect between the two is not highly unusual. I would also say that as we think about next year, we do like equities. We do like U.S. equities in particular. We think earnings would continue to carry equity momentum forward. And we also are bringing down our conviction to long duration treasuries to now underweight because we do think that even though the macro environment may support the Fed to keep cutting, considerations for fiscal trajectory will ultimately come to bind over the horizon of 12 months, which is why we expect term premium to push higher, and we are underweight long duration treasuries. We prefer to click the income and coupon on the front end and the belly of the curve, and for the same reason we have been underweight JGB, Japanese government bonds, and we go even more underweight because of the fiscal dynamics.
And what we saw over the past couple of trading sessions, I'm just wondering whether you're underweight U.S. assets as well, whether you see the U.S. still being the bastion of growth, particularly when it comes to this AI trade, or if you see it migrating elsewhere, especially as more focus turns to places like China.
Well, we have the overweight in U.S. equities, and we certainly expect, because of the key theme of micro becoming macro, actually AI capex spend supporting U.S. growth. It's already kind of, its contribution to U.S. growth is at 3 times the historical level, so it's tracking this year already at elevated levels. We expect that to continue even if labor market cools down. So micro supporting macro is something that we expect to happen and continue for next year. But there is room to broaden out, and here I'm specifically talking about kind of even markets like Europe that doesn't have as much concentration in technology as the US. But if you look at financial as a sector, they are actually ripe for disruption from greater integration of AI, and our investors are quite excited about that opportunities as well. We've been overweight European financials, and we stay overweight European financials.
Wei Li, wonderful to see you. Thank you so much for being with us as you put out the outlook on today, not yesterday. Wei Li of BlackRock with us. Right now, let's get you an update on stories else for this morning. Here's your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. White House Special Envoy Steve Witkoff is in Moscow today. He's meeting with Russian President Vladimir Putin to discuss the latest proposal to end the war with Ukraine. Ahead of the meeting, Putin said Russian troops took over the city of Pokrovsk in Ukraine's eastern Donetsk region, but Ukraine's military spokesman denied the claim. Meanwhile, shares of Warner Brothers Discovery are rising in the pre-market, up about 1% after Netflix made a mostly cash offer for the company in a new round of bids. Sources telling us here at Bloomberg the offers are binding, which means the board can sign off on a deal quickly if its goals are met. Warner Brothers put itself up for sale back in October after receiving multiple unsolicited offers for all or part of the company. And week 13 of the NFL season wrapped up with the New England Patriots taking down the New York Giants 33-15, securing their 10th straight win and becoming the first team to reach 11 victories this season. Meanwhile, the struggling Giants are now on a 7-game losing streak, officially falling behind the Jets in the standings, who secured their 3rd win of the year this past week. That's your Bloomberg Brief, Lisa.
Thank you so much, Yahira. Up next, defending the Department of War.
President Trump and Secretary Hegseth have made it clear that presidentially designated narco-terrorist groups are subject to lethal targeting in accordance with the laws of war.
Cristiani of JP Morgan Private Bank joining us next for the implications for the Latin American region. This is Bloomberg Surveillance. A lift to markets ahead of the open after a pretty rocky start yesterday is what we saw in futures are lifting pretty much across the board, although backing away from some of the earlier highs, up now just 0.2% on the S&P, up 0.3 on the NASDAQ. You are seeing yields continue to inflect higher. Watch this space, up 3 basis points now, 4.11 on the 10-year yields. Wei Li of BlackRock on just moments ago saying that they are now underweight the long-term treasury because of concerns around the fiscal backdrop. Under surveillance this morning, defending the Department of War.
President Trump and Secretary Hegseth have made it clear that presidentially designated narco-terrorist groups are subject to lethal targeting in accordance with the laws of war. If narco-terrorists, again, are trafficking illegal drugs towards the United States, he has the authority to kill them.
Here's the latest. The White House defending the Pentagon's handling of a September attack on an alleged drug-running boat amid escalating tensions between the U.S. and Venezuela. Annmarie, I'm trying to understand the importance of the cabinet meeting that we have later today, given some of the concerns that are swirling around this particular episode.
Well, buckle up, and if you're a reporter, wear comfortable shoes, because I was in the last one. It was more than 3 hours long, longest cabinet meeting, I think, ever in history. But clearly the president is going to get asked questions about this. Defense Secretary Pete Hegseth should be there and give a report, and he might likely be asked questions about this. The issue comes down to, and I think it's a distinction without a cause, they're trying to say, well, this was in the rights of the Navy admiral. But the issue comes down to, at the end of the day, did Pete Hegseth order this, basically saying everyone should be killed, according to the Washington Post? The White House is denying that. But you have Republicans and Democrats on Capitol Hill that want an investigation into this, and they're going to be looking into this, which is why it's making it incredibly complicated right now for the White House as they continue to back the defense secretary.
Well, this is exactly the point, the splintering in the Republican Party. How much is there some sort of consensus, or is this really highlighting some of the gaps that are growing within the Republican caucus?
Well, I think at the end of the day, a lot of senators feel like they have a duty also as well to their committees, and they want to potentially get to the bottom of it. You have some of them saying they're also going to be looking into the Navy admiral to understand from his point of view what the directive was and why he ordered that second strike. Potentially, because you have these individuals wanting to have this investigation, it will fracture relationships with the Oval Office.
This also highlights how much the U.S. is placing a greater import on Latin America. And really the question is, why now? And how well are they doing in terms of trying to increase influence after years of China really increasing their presence? Nor Cristiani of JP Morgan Private Bank writing, in a time of increasing global fragmentation, South America is well positioned to benefit from the evolving landscape of international economic alliances. Nora joins us now. Nora, thank you so much for being here. Wonderful to see you again. I want to start with that question. Why and why now is the U.S. going so aggressively into Latin America? Why is this such an important region?
I think that from the very beginning of the new administration, the current administration in the U.S., we have seen a strategic prioritization of the relationship with Latin America. But a bit of a twist from the traditional Monroe Doctrine, America for the Americans. It's more about the transactional nature of the economic benefits that the U.S. can reap out of the relationship that it establishes or exists with countries in Latin America. Particularly, I think of importance is the issue of South America. It's common perception that the U.S. tends to be the biggest trade partner or the most important economic partner for the region, whereas in recent years, and you pointed it out really nicely, China has taken a much larger role, especially for South America. In fact, I would venture even in saying that the majority, if not all of the countries in South America, their largest trading and economic partner is China. And a clear example of that is the recent investments that we saw on Peru, for example, the port of Chancay, $3.5 billion, fully funded by the Chinese investors. So the presence of China in Latin America, particularly in South America, in a juncture in which we're seeing that the world, and especially the US, wants what Latin America has to offer: natural resources, benign demographics, geographical proximity. All of that places Latin America in a really good spot at the moment from a bargaining position.
Are Latin American investors happy about the U.S. trying to take a bigger role potentially in the region?
The way that I would spin that question is that local investors or the business community in Latin America is very much looking forward to a regime changes, I would say, across the region. And that when you said at the beginning, why now? It's not just the why, right? I think the why is very well known, the abundance of natural resources. And we've talked about that at length. It's the why now, the key question that we need to be asking ourselves. And the reason why we are so positive in Latin America, and particularly South America, which we highlight in our outlook for 2026, is precisely due to two reasons. One is the possibility of the political pendulum swinging from years of left-leaning administrations that were very focused on social spending, sacrificing fiscal deficits in pro their own benefit, towards possibly a more center-right regimes that instead of prioritizing spending, they start prioritizing investments, right? So that's number one. And number two is the AI revolution and the setup that we have globally make what Latin America has to offer even more valuable. So I think that when you ask me the question, are business people happy about the incursions that we're seeing or the participation, the actions that the U.S. is undertaking for all of Latin America or throughout Latin America, I would say that it's more likely that they are more constructive on the possibility that now the regions are going to be finally able to monetize the competitive advantages that the region has boasted for so long.
But do they need to choose between Washington and Beijing?
Not necessarily. And I think a clear example of that was what happened with Brazil when the administration back Liberation Day, you must remember very well, came out with tariffs, and then a few months later, 50% tariffs on all Brazilian goods. The administration in Brazil turned around and said, well, in reality, our biggest trading partner is China. So there's a little bit more bargaining there between the two. So I think that there is a point in which Latin American governments and countries' economies in general, they don't necessarily have to choose. They can interact with both, and leaning in on their own best benefit rather than just yielding everything to a single partner.
Not to get into politics, but to circle back with what we started when it comes to Venezuela, I think of Chevron being like the only U.S. company left there. Could you see a world in which it could be a place to invest again?
Latin America?
Venezuela.
There's all the benefits that we discussed for Latin America in general are also present in Venezuela. Venezuela, for example, is the country with the largest oil reserves in the world. It's one of the largest oil producing countries in the world. So there's definitely opportunities there that can be garnered once there's greater appetite and a greater perception of higher IRRs for projects developed in the region, for sure. Not just Venezuela, the entire region could benefit from the same environment.
Noor Cristiani, thank you so much for taking the time today. Always wonderful to speak with you. Noor Cristiani of JP Morgan Private Bank. This really is a key question, right? Which is, in other words, how do investors follow some of these geopolitical crosswinds? And frankly, a clear effort on the part of Washington, D.C. to put a more significant stamp on Latin America at a time where there are a lot of asterisks around exactly doing that.
And when you look at Latin America, what the administration is trying to do is so many pillars at one time. They want to go after what they would call narco-terrorists in some of these countries when it comes to drug inflow into the United States. They want to push China out, and they want to go after the natural resources because they need them if they want to diversify against the rare earths and the raw materials that come out of China.
Everything, everywhere, all at once. Isn't that the strategy? Is that what you were talking about, which we've seen throughout the morning? Coming up in the next hour, Katy Kaminski of Alphasimplex Group, National Retail Federation President Matt Shay. Cyber Monday was yesterday. We'll get a read on exactly what happened there. Lindsey Piegza of Stifel and Tom Narayan of RBC, as we do get some auto sales reports coming out throughout the morning. From New York, this is Bloomberg Surveillance. Good morning.
AI is a bubble. We're starting to see that cash flow headroom coming down.
It's still going to drive markets. There is a fair amount of capital on the sidelines.
The theme is the same theme going into the internet boom. If you're not exposed, you're really going to miss out.
I still think there's a lot more buying opportunities and money to go into the equity markets here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. As we do see a bit of a reprieve from yesterday's risk-off feel, seeing that lift across the board in benchmark futures, seeing about a 0.2% gain for the S&P 500. Meanwhile, in the bond space, this really is catching a lot of our attention. The 10-year yields are continuing to climb after yesterday seeing the biggest one-day pop going back about a month now, firmly over that 410 mark, almost 411. And a real question as we head into year-end about just how much the AI story is transforming, with ChatGPT founder Sam Altman in his OpenAI talking about code red heading forward based on increasing competition, Annmarie, from Gemini.
Exactly, and they're at the moment they're committed to hundreds of billions of dollars when it comes to the build out. So this is potentially could be viewed as a cause for concern. The market seems to be shrugging it off today. They're not really focused on this specifically, but when you have this idea of you're concerned about an AI bubble, now you are seeing a serious arms race and concerned when it comes to OpenAI. It's no longer the vibes are not right, we need to work harder, a memo we saw recently. This memo is code red. Stop everything. We're not going to focus on all this other stuff potentially with building out when it comes to advertisement. We need to focus on the product at hand. And this is exactly what Google went through. But to Cameron Dawson's point, maybe the market likes seeing this. They want to see that competition and that fight within these companies.
Well, Wei Li was talking about remaining nimble in the new AI dominance that we see in 2026. And this does seem to be what a lot of people are talking about, remaining nimble when it comes to policies that have highlighted, that have been so profoundly different than what people expected. And I think about, for example, earlier this year, just switching topics to the fiscal backdrop, how much people are talking about tariffs as being a headwind potentially to growth. Now there is a question about how much the potential removal of tariffs could be a headwind to the fiscal backdrop for the United States, and part of the catalyst to the sell-off that we saw in treasuries yesterday, as Cameron Dawson of NewEdge was saying earlier this morning.
Well, potentially, and the idea that Costco's lining up to make sure they have their suit on file to say that they do think that IEEPA is unlawful, so that potentially they can make sure they get their reimbursements if it happens, shows signs of companies are starting to really pay attention to this. The bottom line, though, how I always viewed IEEPA is it's basically mute. If IEEPA gets struck down, it'll take a lot longer, but there are a number of legal avenues the administration has at their disposal to enact tariffs. It's just going to take a lot longer.
Well, this is the reason why people are watching what happens at the Supreme Court case. In the meantime, we're not talking about non-farm payrolls because we're not getting non-farm payrolls on Friday. What we are getting is ISM services coming out tomorrow after we get some CoreWeave earnings later today and an announcement from President Trump, as there is this real focus on affordability. We also get ADP data tomorrow, jobless claims Thursday, and then we get core PCE on Friday. Yay, data. Of course, it is September, so it is dated data, and it really does go to the last clean read, as Andrew Hollenhorst over at Citigroup was saying, on inflation. Coming up this hour, Katy Kaminski of Alphasimplex Group with stocks trying to find their footing after a rocky start to the month. Matt Shay of National Retail Federation breaking down Cyber Monday sales, and Lindsey Piegza of Stifel warning that further Fed policy easing could fuel pricing pressures. We begin this hour with stocks edging higher following a weak start to the trading month. Katy Kaminski of Alphasimplex Group writing, rate cut optimism has boosted small cap and mid cap stocks more than AI and big tech. Overall investor sentiment has stabilized, but fears still remain for overvaluation. Katy joins us now. Katy, I wanted to start with your understanding of what actually has been happening in markets over the past couple of trading sessions. It seems like there is an increasing breakdown in risk led by Bitcoin, maybe a bit of a stabilization. But from a technical standpoint, what do you see?
This is a good point, because what we have seen, you've definitely seen a breakdown in some of the recent trends. There has been a shift in sentiment overall, and you're starting to see some deterioration in some of the key themes. Of course, gold being something that has been selling off today. And it is also surprising that you're also seeing yields higher when rate cut optimism should be a positive for them. So I think that just highlights the amount of uncertainty and the potential for risk off sentiment when people are concerned about high valuations.
One thing that really I was looking forward to speaking with you, Katy, because when you're following trends, sometimes you can find the pivot points and understand there is something different here. We're not going to see maybe the melt up rally that we typically do in December heading into year end. Are you sensing that there is some sort of pivot going on under the hood in markets?
Well, this is a very good point, because technically December is generally one of the better months for equity markets. There tends to be a lot of positive sentiment. But I think in the backdrop of some tepid economic information, some weaker labor data, people are getting a little more nervous. So there is some indication, at least with some of the price reversals that we've seen. I think some of these other asset classes like Bitcoin, even now gold selling off some, suggests that there is chance for some deterioration in equity markets.
Katy, is it Japan, ISM, the waiting on IEEPA, or is the market just basically looking for an excuse to hold pat at the moment, especially when there's a number of questions still going into year end, most notably the Fed next week?
This is a good point because there's not a lot of data to hang on to. There's definitely mixed data. And I think with concerns of overvaluation and just how exposed many investors are to these themes, there is some clear uncertainty there. But what's interesting to me is you see like small cap has been doing a lot better, for example, than big tech. And that's just a little bit of a reversal from what we've seen typically this year. So you're just seeing a little bit of pivoting, a little bit of changing direction, which suggests that we might be in for a change in trend moves at some point.
Lisa pointed out that the PCE data we're going to get on Friday is very stale. This is from September. So when you look at the data coming out, what do you want to hang your hat on?
That's a good question. I mean, obviously, we'll start to get more data next week. I'd say that there's not a lot for investors to hang on to at this point. And it really is sort of the end of the year, which tends to be a very positive environment. So I think they're focused much more on sort of following the narrative for rate cuts for next week. That seems to be the only major thing to follow and see what's going on. But you're correct. There's not a lot of very pivotal data that's going to help us figure out what's really going on.
Well, this goes back to something you were saying earlier. If you're following rate cuts, why are yields rising?
Exactly. I mean, I would guess that that's probably a reaction to what is going on in Japan. Clearly, we saw the potential for hikes there causing treasury yields to move upwards. Besides that, I mean, it is slightly counterintuitive for yields to be rising going into a potential for rate cut. But this just may have to do with some of the uncertainty. I know that there's been a lot of discussion about disagreement within the Fed, so that may be causing a little bit of jitters in the bond markets.
Yesterday, we did see 10-year and 2-year Japanese bond yields reach the highest levels that we've seen going back to 2008. The expectation was that you were going to see a rate hike at the next Bank of Japan meeting. That said, earlier in the morning, it wasn't when we saw the yields creep higher. It was after the ISM manufacturing data. And then, as Cameron Dawson was pointing out, it was after the story about Costco potentially laying the groundwork to reclaim some of the revenue, some of the tariffs that they paid over the course of this year in the case of a Supreme Court ruling. Which of these narratives makes the most sense to you, or do you think that there's something else entirely?
Well, really, it's very tricky, right? Because you have market moves that seem counterintuitive to general macroeconomic themes, such as the Fed rate cuts. Then you have, Japan, which is moving in a different direction. And as you just pointed out, you're also seeing some weakness in labor data and manufacturing, which paints a more concerning picture about the general U.S. economy. And especially if you're thinking about long-term bonds, there may be some questions of whether or not rates can stay low for long if we sort of don't know what's going on next. So you're right. It's very tricky right now.
When you start thinking about the Fed meeting next week, the market is baking in this idea of another interest rate cut, but you're talking about maybe some disagreement at the Federal Reserve. Do you think there's a potential that they stay pat and on pause?
Right now, the market is not thinking that, but given the level of disagreement, the level of uncertainty, and the wide range of potential outcomes, I think we haven't had this level of disagreement in the Fed for almost 13 years or longer. So just given that sort of range of outcomes, there's always a probability you're going to have more disagreement or more disappointment than if you have a lot of consensus on the Fed.
If the Fed does pause and does not cut interest rates, will there be a Santa rally as Lisa started the program off this morning?
Oh, that's a good question. I mean, that could definitely put a pause on a Santa rally because you look at how small cap U.S. stocks have really reacted. There's clearly that would be a headwind for many equity investors. And I do think that could be, a potential negative for equity markets should they not deliver as people expect.
Katy Kaminski of Alphasimplex, thank you so much for being with us this morning. Katy, there talking about the Santa rally. You mentioned this heading into year end. And look, the Fed's going to cut rates. That's the 95% chance, at least baked into Fed funds futures. If it is a hawkish cut, I know that we're going to be getting into this. What does that signal to markets at a time when that really is maybe the only thing that people can hang their hat on based on the dearth of other economic data points to really go on?
And then how awkward will it be for the Fed depending on what they do and what the jobs number comes out with the week after. This is why, for some people, it is just still unbelievable that they just didn't move the Fed meeting until after they got all the data.
Some people being Annmarie Hordern, who is lobbying hard to get it to be moved the day after we get that data. Keep trying. I think a lot of people would agree with you.
It just makes sense.
It does make sense, but they're not going to do it. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Dell founder and CEO Michael Dell and his wife Susan are donating over $6 billion to the Invest America initiative, also known as Trump Accounts. The unprecedented gift will give 25 million American children aged 10 and under $250 each to start an investment account. Dell saying the goal is to build hope and opportunity for the next generation. Meanwhile, shares of Warner Bros. Discovery are rising 1.3% in the pre-market after Netflix made a mostly cash offer for the company in a new round of bids. Sources telling us here at Bloomberg the offers are binding, which means the board can sign off on a deal quickly if the goals are met. Warner Bros. Put itself up for sale back in October after receiving multiple unsolicited offers for all or part of the company. And Big Short investor Michael Burry is betting against Tesla. Fortune reporting that Burry, best known for betting against the housing market during the 2008 financial crisis, says Tesla is ridiculously overvalued. He is also warning that founder Elon Musk's proposed $1 trillion pay package would worsen shareholder dilution. That's your Bloomberg Brief, Lisa.
Thank you so much, Yahira. I thought it was amazing. He actually calculated the dilution, saying it was 3.6% of dilution in the shares. It does seem like people are kind of betting against the wind, though, and they're trying to short some of these big tech names.
Oh, absolutely. I mean, in Tesla, shares have gained more than 6% this year, even though they've had a tremendous amount of hurdles come down when it comes to a number of issues facing that company, especially when it comes to EVs, deliveries, what's going on in Washington, D.C., change of policy. They're still on a tear.
Yeah, we're going to get into the auto story later this hour. Up next, the morning calls, plus Matt Shay of National Retail Federation breaking down Cyber Monday sales following Black Friday sales. What's next? Happy Tuesday sales. This is Bloomberg Surveillance.
We are still seeing that investors are sitting on the sidelines of this market, mostly in institutional investors. And we feel like a bit of a broken record in saying that institutional investors are just neutral. Because you still have institutions sitting on the sideline, it means that short and shallow dips are likely what we get.
That was Cameron Dawson of NewEdge Wealth earlier this morning as she was looking ahead to the potential for people to step in and buy. They are stepping in and buying right now. You are seeing a bit of a lift across the board, a reprieve from yesterday. Russell 2000 actually continuing to gain up 0.6% in our early trading, leading the pack, even though what you see in the bond space is an ongoing lift in longer term yields. This coming despite expectations for a Fed rate cut next week. We do see almost 4.11 on the 10-year yield. Time now for the morning calls. First up, Wells Fargo raising its price target on Casey's General Stores to $625, saying the company looks, quote, poised for a Q2 beat and raise. Those shares lower by about 0.25%. Next up, Truist upgrading Six Flags to buy from hold, but cutting its price target to $23 from $27, citing a new CEO and greater sense of urgency. Six Flags up 4.2% in pre-trading activity. And finally, Guggenheim Securities raising its target at Five Below to $185, maintaining a buy rating, citing meaningful intermediate term upside potential for people who want to buy gummies. 1.9% decline on those shares. Doesn't it seem like what a Five Below is? It's for kids who are in, junior high school buying gummy candy.
I'm not sure. I don't think I've actually been inside of one, so we're going to have to do some market research.
Evidently,
someone's got
to give you some deals to potentially get in the door. Sticking with retail, the National Retail Federation forecasting 2025 holiday sales to exceed $1 trillion for the first time. Joining us now, I'm so pleased to say, is Matt Shay, CEO and president of the National Retail Federation. Matt, thank you so much for being with us. First, I just want to get a sense of how much that $1 trillion figure and how much some of the increases that we've seen in sales during this holiday shopping season have really stemmed from just higher prices, not necessarily a greater degree of volume.
Well, good morning. Happy to be with you today to talk about the big holiday weekend on Cyber Tuesday now, but we had a great weekend. We had tens of millions of Americans out shopping. We're going to be releasing the results of the weekend on our holiday call at 11 o'clock this morning, 11 Eastern. So I think what we saw was retailers delivering real value to consumers. And while there have been some price increases throughout the system, through this whole year, retailers have worked very, very hard to keep delivering value for customers and to avoid passing on any price increases. So we're looking at maybe 1% price increases on food. And really, for the last couple of years, we've been seeing on the good side flat to down on inflation. So there's real growth there with a 4% forecast. Our forecast, 3.7 to 4.2%. We'll see real growth this year. And I think you saw some great deals over the weekend and saw some retailers that were really winning with customers.
So let's talk about this period of discounting. It was Black Friday, then it was Cyber Monday, where actually there are potentially steeper discounts, averaging 31% compared with 28% on Black Friday. Now we're on to, let's go teetotaling Tuesday or something. I mean, it seems like it's just continuing in terms of the sales and the promotions. Does that indicate that retailers are looking to clear their shelves? So does that indicate that there just is a need to generate eyeballs, or is it just that they feel like they want to give a sense of value to their customers?
Well, I think there are a couple of things happening here. First of all, I think we begin with inventory levels. And inventory levels are in a very good place on a historic basis. So we're about 1.13, which means we've got a little more than a month's supply for a month's worth of sales. So they're not holding too much inventory. They've got the right inventory in place. I think it's a very competitive retail environment. Consumers are under some pressure at the lower end, but they're still out there spending. And we're on track to have a very good year overall, probably in the 4% range for the year. And what we're seeing is consumers are being very deliberate, very thoughtful, very purposeful. They've got lots of information at their fingertips. They're really looking for the best deals they can find, the best value based on the things they need and want. So I think what we see is a competitive landscape, inventory levels in a good place. Margins are holding up very well for retailers across the board. And the promotions we've seen have been planned promotions. So there's this is all part of a planned rollout for the holiday season. And I think thus far it's going really well. We're off to a great start for the 5-day holiday weekend here for Thanksgiving.
Matt, to Lisa's point, though, maybe we call it Tardy Transaction Tuesday. I am getting nonstop emails this morning about how Cyber Monday has been, quote, extended. And to be honest, I actually took advantage of them very early this morning, something I forgot I wanted to purchase. Are you saying that is all planned and this basically just becomes a discount week? Or does it actually show that these retailers are really desperate to try to get eyeballs and individuals back on their sites?
Well, I think, Annmarie, I think one thing we've seen is the holiday season has been extended over the last several years. And certainly since the pandemic, we've seen consumers beginning their shopping much, much earlier than was traditionally the case. And we see retailers delivering those deals all the way back into the summer and throughout the fall. So what we're seeing now, I think, is a continuation of that. They're going to continue to be day by day, week by week, different kinds of promotions, different kinds of rollouts that are going to be designed to attract consumer engagement throughout the holiday season. And I think that this has all been this is a thoughtful series of deliberate sort of promotions that are out there. They're planned. They're responding to what consumers are looking for. And I think back to the competitive landscape that we're operating in, we're not in the period where every retailer is a winner and every business is going to win the way we saw in 21, 22, 23 even. This is an environment in which it's much more competitive. And so retailers are trying to distinguish themselves in the marketplace, deliver that real value. And value is, I think, more complicated. It's not just price. For some consumers, value is price. But it can be quality, it can be selection, it can be convenience when it comes to fulfillment, delivery. So when consumers say they're looking for value, they're looking for something that makes them feel they got what they paid for. And that might be a great quality item. That might be an item that gets delivered more quickly than they could get it from another competitor. So I think there's a whole series of things that we use when we say value. We're talking about a series of different kinds of experiences based on the consumer. And again, we'll talk more about this at 11 this morning, but we saw retailers really delivering value through this weekend. The numbers were good. Traffic was good online, in store. So I think we're off to a very healthy holiday season.
Stepping away from the holiday season for a moment, can you give us a sense of how retailers are dealing with tariffs and this potential of IEEPA being struck down? Are they talking about potentially benefiting for the reimbursements that might be needed to be paid back to them if the Supreme Court deems that IEEPA was illegal?
Well, I think what we've seen this year, and again, going back to the pandemic, we've seen for the last 5 years, this great period of disruption, this period of uncertainty, unpredictability, even volatility across the market, things that are outside the control of a retail business or any business for that matter. And so I think as we look forward, retailers, again, are focused on the things they can control. And what they can control, the relationship with their partners, their suppliers. They can be creative and thoughtful about the way they're handling their sourcing, their inventory, their importing, the way they're communicating with customers. Those are all things they can control. What the court does or doesn't do when it finally issues a decision on the tariffs, I think that's something that we can't control, our members can't control, and we'll handle that when we get to it. So I don't think anyone's counting on a result one way or the other. It's what we're looking for is certainty, predictability, something that'll smooth out the relationships in the supply chain. And the court will make a decision, and we'll certainly go from there based on what the court decides.
Matt Shay of the National Retail Federation, thank you so much for being with us. And I have to say, Annmarie, you get a gold medal. Tardy transaction Tuesday. That's absolutely brilliant.
Because it feels like it's for that person that maybe did want to buy something and then was just like, I'll wait.
Yeah, and then they say to you, we see it in the cart. You maybe want to do this a little bit longer.
I'll be fair. They got me on Tuesday.
Yeah, well, I will say that the gummy selection definitely on fire over at Five Below. Thanksgiving transition Tuesday. Tinsel Tuesday, Tipsy Tuesday. I mean, we really could go further on this. I really think you have something here.
It's becoming an entire week. But to Matt's point, he says that this is all deliberate. So they understand that consumers maybe are, actually, maybe for fickle. Maybe they're going to see how much they decided to spend for the holiday season on Friday and throughout the weekend on Monday. So then they still continue those offers throughout the week. But the fact that I think they're still trying to find those eyeballs and get you back to their website says that things are not as rosy potentially as they seem, and they have to really fight for consumer attention.
Well, we'll carry that conversation forward. Just how clean of a read can we get on the consumer from some of these retail earnings and frankly from the other peripheral data that we are getting. Coming up, Lindsey Piegza of Stifel warning that further Fed policy easing could fuel pricing pressures. Plus, Danny Berger with your morning movers. Warner Brothers Discovery rising after Netflix offers cash. I did not mean to sell Annmarie on Five Below, but here she is lost in an absolute. Well, I mean, if you have kids, then that's typically what happens. I'm not selling them. I'm just saying that this is sort of a good rainy day activity. Right now, we're looking at other rainy day activities because it is a rainy day here in New York City for the Northeasterner. Up 0.3%, not necessarily so dire or dismal in the futures space. Higher across the board, led by actually the Russell 2000 futures up 0.6%, NASDAQ up 0.4% in the bond space. Curious to see that there is not the participation in the rally. Yields up across the board. 10-year yields 4.11 after yesterday climbing 7 basis points at the long end. 30-year yields up just 2 basis points. A bigger move in the belly there, and a real question about what is driving it. Is it a question of potentially tariffs? Is it a question of the Bank of Japan? And in the currency space, pretty much quiet across the board. A little bit of maybe euro strength, but really flat. 1 hour away from the cash open. Your morning movers here with Danny Berger. Danny.
Hey, Lisa, one of the stocks we're going to keep talking about this morning is Warner Brothers Discovery. Shares are up 1.5%. Reporting suggests that we're looking at second round bids for the company. All the players that were there are still participating in it. All eyes on Netflix with offering a mostly cash bid. We also are expecting something of a $30 bid. At least that's what Warner Brothers Discovery wants to see. Reportedly, shares currently at $24 Elsewhere, Boeing seems to be perking up this morning. Some headlines coming out of the UBS Industrial Conference where their CFO was speaking, saying that Boeing's recovery is in full mode. He did cite some weaker sales, or at least a little bit of a lightness when it comes to November, but looking ahead to 2026, shares up 3.5%. Finally, ending things with a little bit of sell-side action. That is on Six Flags. Truist upgrading the stock from a hold to a buy. It's been a struggle for Six Flags. They have activist investors swirling around. They put in a new CEO, and according to Truist, that is the key for them. They say that there's a new sense of urgency to get rid of the parks that are underperforming, focus on the core. So again, those shares up more than 4% this morning, Lisa.
Thank you so much, Danny. Meanwhile, Amazon's AWS reInvent 2025 is underway in Las Vegas this week, with the tech giant unveiling product news and announcements. Bloomberg's Ed Ludlow joins us now. And Ed, it is really interesting to be tracking this event at a time where there's so many questions around what the new innovation is going to be for artificial intelligence, who the leaders are going to be. What's your sense of what some of these announcements could look like?
Yeah, there's pressure on Amazon because AWS is the number one in cloud, right, in terms of scale, hosting, infrastructure. But is it the number one in AI? That's all that anyone really cares about. And that's multifaceted. Is it number one in terms of the models that it offers? Is it number one in terms of the performance of its own chip? And so far, the announcements that they have made, which are few and far between, have focused on the model that they've had out for a year, which is their own. It's called Nova. It's a foundation model. And the agentic AI that's built on top of it. You know, Amazon Web Services is a place where there are loads of different tools. And the complaint from industry has been, no matter how price competitive it is, it's quite confusing to use. And if you look at what's coming from OpenAI, Google in the form of Gemini, they're just one-stop kind of shops. And so, you know, when we get the keynote later this morning, 11 a.m. Eastern, you expect some fighting talk for Amazon to say, actually, we've got our act together. This is what you can do if you want to build with AI on our cloud.
Ed, just a quick note here on OpenAI and this question of competition, because they also feel like they are somewhat not behind, but facing increased competition from Alphabet's Gemini. How much are you feeling like this is a healthy phenomenon from the industry, and how much do you feel like this is cannibalization, where the strongest hands are going to win?
Yeah, it's certainly timely. You know, the reports that Sam Altman's called Code Red and basically wants OpenAI to focus just on ChatGPT, highly relevant to what's happening here, right? AWS has a $38 billion deal with OpenAI, but that's for NVIDIA chips. That brings into question if OpenAI has overextended itself on its capital commitments for capacity. Amazon has historically been a place where they host other people's models, but they want to sell their own. OpenAI wants a foothold on the enterprise, so it's looking to Amazon. And in the background, you have Google and Google's TPU, the performance of its own A6 chip. Amazon very likely to talk about their own in-house silicon, but they don't really have anyone to use it beyond Anthropic, one single anchor investment. You use the word cannibalization. You know, the question is still not necessarily on bubble, but overextended. And are these model labs good for the money that they've committed to the hyperscalers who themselves want to be leaders in the field of foundation models and building cool software on top of it? All fair questions to ask throughout the course of the day.
And I'm sure that you'll be asking them. Ed Ludlow there, he is going to be speaking with the CEO of AWS later today, I believe at 3:10 p.m. Eastern time. AI dominant in the U.S. economy, Wei Li of BlackRock, talking about how the micro is turning into macro.
There is no such a thing as neutral stance anymore. So if we look at the large numbers of CapEx forecast, credible forecast takes us to $8 trillion by the end of this decade. The current forecast for big tech companies in terms of incremental revenue do not justify this amount of spending yet.
Increasingly, the AI story is becoming the economic story. Bloomberg's Enda Curran joins us now. Yesterday, we saw a stagflationary ISM manufacturing report, which kind of flies in the face of this huge outgrowth of investment that so many people are expecting from artificial intelligence. At what point are you able to track, or are we sort of at the behest of the AI developments, especially at a time when we don't have other economic data?
Well, we know that AI is certainly accounting for the bulk of GDP growth this year, Lisa. It's certainly driving activity, as you point out, in the broader manufacturing sector remaining in the doldrums. That ISM indicator yesterday showing 9 months of contraction because of the uncertainty over trade policy, because of weak demand. So you look around, where is the activity coming from? And it is that AI build out, it is the investment, it is the data center story. But in terms of how sustainable that will be for the economy, what legacy of employment that will leave once the construction phase is over, and of course what impact the AI boom is having on productivity, all of that is very uncertain right now. It's very hard to measure. It is boosting headline aggregate data, we know that, but we also hear a lot of stories, just like a previous guest making the point about the retail story. Sounds like it's booming, but of course plenty of economists say that's concentrated in terms of upper income households. So yes, we're getting a good gloss on the economy from the AI story, but there's a lot of uncertainty in terms of what's happening in the other pockets of the economy.
And what's your compass right now, given the fact that we don't get non-farm payrolls, we don't get jolts, we don't get a whole host of other key indicators this week?
Well, it's hard to have a compass, Lisa. I mean, we have ADP coming up tomorrow. Consensus there maybe plus 5,000. That's fairly tepid in itself. If that was to be a negative number, it would just back up the idea that the labour market is weakening. If that's all the official sector has to go on at the moment, and Wall Street analysts have to go on, because we don't have that flow of the BLS jobs data or the CPI data. That said, though, it does feel like we're at a point where the Fed officials have probably made up their mind. You're either more worried about inflation, and that's where your focus is right now. You've decided that the labour market is what it is, or you're more concerned about the job story. And by all accounts, the hints that we had heading into the blackout week at the end of last week it sounded like some of those more prominent Fed officials were more worried about jobs, and that's why the markets, of course, are now pricing for that Fed rate cut next week. But without the data, it's going to be a very hard Fed meeting to call.
And Curran, thank you so much for being with us, as always. Sticking with the Fed ahead of next week's meeting, Lindsey Piegza of Stifel, clearly in the inflation camp of worries, writing, while inflation held steady in September, the lack of downward improvement from a still elevated level raises concerns that any further policy easing could risk an acceleration of price pressures. Lindsey joins us now. Lindsey, thank you so much for being with us. I want to start there. Why are you still concerned about inflation worries being the preeminent concern at a time when it seems like the Fed has moved more to the employment side of the equation?
Well, it does seem at least some Fed officials have shifted their focus away from price stability to full employment. But there are still a number of Fed officials that have come out to highlight the need to remain focused on reinstating price stability after years of allowing price pressures to remain above that 2% target. Now, we have made considerable progress in terms of reining in that growth in the aftermath of the pandemic, but we've never been able to get back to that point of price stability. And now, with this lack of downward momentum, it does suggest that the Fed might have reached a neutral position in policy, appropriate now to take a position, a sidelined position, without further rate cuts, without further risk of inciting inflation. Particularly now, there are a number of upside risks as we look out to the end of the year and turn the calendar page into 2026. So now is not the time to entirely divert focus away from achieving price stability.
Lindsey, do you think that the Fed has enough information and data, given what happened with the government shutdown, to make a decision next week?
I think the Fed has a good read on what's happening in terms of the underlying momentum in terms of cost pressures. Again, we haven't seen necessarily all of the data move to the upside, but we haven't seen any indications of a material downward momentum in inflation. And as such, I do think, coupled with the fact that consumer still remains on far from robust but solid footing, the economy is on track for a plus 3% growth pace. And we continue to see, again, not robust, but positive, solid job creation. I think the Fed should err on the side of caution, moving to the sideline, allowing for a further understanding of the evolution of both the price and the labor data before making any additional policy adjustments.
Lisa brought this up earlier, if potentially it's a hawkish cut. But what you're describing is maybe we have a dovish pause next week. Is that correct?
Not necessarily a dovish pause. I think we're looking for more of a neutral pause. I think the Fed at this point is pretty well divided between those that have that lingering fear of price pressures and those that are facing this emerging concern of weakness on the labor market front. So I do think the Fed could very clearly articulate a neutral pause, push policy to the sidelines, say we're not going to make any unnecessary movements until we have a better read on prices and the labor market, given there are risks to both sides of the Fed's dual mandate.
Lindsey, when you say inflation pressures are still in the system, there is a real question of what those inflation pressures look like. 3%, a lot of people say we can handle. 4%, not so much. How much are you seeing an actual unmooring of inflation expectations in a way that feels unsustainable and unduly punitive rather than 2.5%? Say, or 2.8%?
Well, I think at the current read, right around 2.5-ish%, I think the Fed would be willing to tolerate that longer term. But my concern is these upside pressures that are still coming down the pipeline. Should we see a stronger than expected growth profile at year end, or a stronger, more spendy consumer as we now enter this key holiday shopping season, or turning the corner into 2026, should businesses now begin to pass through more of those cost increases to the end consumer that were previously absorbed into the bottom line, now that inventories have been drawn down significantly, any one or a combination of those factors could add significant upward pressure to inflation going forward. So it's not necessarily where we sit right now, but the risk to prices, price pressures, as we look out to the remaining months, the remaining weeks, of the year and into 2026.
Lindsey, just real quick here, going forward, I'm curious how effective you think monetary policy really is in tackling some of the issues that are preeminent, particularly when it comes to the K-shaped economy and questions around just how much wages are not keeping pace at the lower end.
Well, wages still are relatively positive. We see about this 4%-ish, but you're right. A lot of that growth has been isolated to the upper end of the income spectrum, fueling a lot of the activity on the retail side in the upper echelon. And so we don't see necessarily this broad-based expenditure. When we talk about the consumer being solid, we do have to be somewhat careful painting with a broad brush because a lot of that momentum has come from this underlying increase in asset valuations, fueling trillions, tens of trillions of dollars in wealth. But again, that's very much isolated to the middle or the upper end of the income spectrum as we're talking about property ownership, participation in the equity market, which those at the lower end, statistically speaking, are less likely to own property or have a stake in the equity market. So we do see, again, not necessarily the Fed's ability to completely ameliorate this K-shaped recovery, but there is a role of monetary policy, but a delicate one. We have to make sure that we're attentive to both that labor market and the price data components of that recovery.
Lindsey Piegza of Stifel, thank you so much for being with us this morning. Right now, let's get you an update on the stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Cloud computing provider Vultr is making a major bet on affordable AI infrastructure. The AMD-backed company announcing plans to spend more than $1 billion building a massive chip cluster in Springfield, Ohio. The facility will use AMD's advanced AI processors to offer computing power at significantly lower rates than major tech giants. Meanwhile, the U.S. Commerce Department agreeing to invest as much as $150 million in X-Lite, a chip technology startup. It's part of an effort to create more domestic chip-making capabilities and help X-Lite construct a laser prototype. X-Lite's executive chairman, Pat Gelsinger, yes, formerly Intel CEO, saying it is a, quote, once-in-a-generation opportunity. And the Northeast is preparing for its first major snowstorm of the season. Some parts of northern New England could see as much as 10 inches of snow. The storm could also drop up to 4 inches of snow in Chicago, where a record 8.4 inches fell at O'Hare International Airport on Saturday. That's Bloomberg Brief. Lisa.
Thank you so much, Yahaira. And I feel for any travelers who are sitting in limbo as a result of those snowstorms. Up next, setting you up for the day ahead. Plus, Tom Narayan of RBC Capital Markets as Michael Burry is betting against Elon Musk and Tesla. And as we do get some auto numbers throughout the day today, this is Bloomberg Surveillance. coming into the second day of December with a little bit better tone than we saw yesterday. Certainly a lift at the S&P, up about 0.3% now. Interesting to see the yield climb on the 10-year. This is very much a focus, especially after the Bank of Japan decision or likely decision to hike rates, as we heard the signal yesterday. A real question of the carryover with 411 almost on the 10-year in the United States, counting down to the opening bell. Here's a trading diary for the week ahead this morning. U.S. envoy Steve Witkoff meeting with Russian President Vladimir Putin in Moscow. At 11:30 a.m. Eastern, President Trump hosting a cabinet meeting, 2 p.m. Eastern. The president set to make an announcement, and after the closing bell, we do get earnings from CrowdStrike. On Wednesday, tomorrow, we get ISM services. On Friday, we get core PCE data. Sounds exciting. It's from September. Don't get too excited. Counting down to the opening bell. Investor Michael Burry making another big call against the market. The big short investor calling Tesla shares ridiculously overvalued. Tom Narayan covers Tesla and other automakers for RBC and joins us now. Tom, great to see you. Thank you for being with us. We can start with Tesla, but I would love to talk about how representative it is of the larger auto space and how difficult it is to get a handle on exactly the supply-demand dynamics at a time of post-pandemic transition and post-tariff realization.
Yeah, and I think what you're noticing more and more is the strength underlying the U.S. economy, especially at the top end and maybe at the middle, is manifesting itself with auto sales, which have actually been stronger than what a lot of people expected. We did our own work to actually show that there's about a 6 to 7 million vehicle deficit of cars that were never purchased because of the pandemic. And, you know, in the U.S., in a lot of states, you have to have a car. It's as simple as that. How do you get to work? And if you can afford the car, you will buy it. And so, you know, at the beginning of the year, I think folks were looking at something like a 15 million vehicle SAAR for 2025. It's looking like it's probably going to be a 16.2, 16.3 million number. So, yes, sure, things are slowing down a little bit. There's been some pricing to offset some tariffs lately with some OEMs. But if you take a step back, there is some real strength of the economy. Unemployment is very low. We'll probably have another rate cut, right, later this year, probably more next year. And then tariff resolution in 2026, especially with the USMCA. So given that backdrop, we're actually pretty constructive on U.S. autos.
So this goes to who's going to win, right? Is it the U.S. auto manufacturers? Is it the electric vehicle manufacturers? Or is it, as we have seen of late, a real shift back to hybrid and, frankly, trucks and away from the Elon Musk's Teslas of the world?
Yeah, I mean, let's just look at cars specifically or autos specifically. I would agree with that. It's ICE cars in the U.S., definitely. Perhaps there's some room for EREV or hybrid. Certainly EVs is not the place to be right now in the U.S. I do think there's room for that maybe later in the decade. But right now, the strength is at the heart of the U.S. auto industry, pickups, large SUVs, ICEs. Think GM, most notably, maybe Ford as well, some Stellantis. So we think that's really where you'll see most of the benefit near term, not as much with the EV space in the U.S.
EV space has certainly been under pressure. At the same time, though, Tom, you have an outperform on Tesla. Why do you continue to like this company?
Yeah, it's certainly not really because of autos. It has more to do with the AI features, right? So robotaxi, you guys well know my thoughts on robotaxi, and then now the humanoid market. And yes, look, it's very early to tell where Tesla's going to be in that. So I look at Tesla the same way on humanoids as I do on robotaxi, which is I look at the top down. I think it's a huge market opportunity, both humanoids and robotaxi. And I'm assuming actually very small penetration levels for Tesla on humanoids, only 5% of that market. It's a big opportunity, this humanoid market. I don't think the investor base has caught up with reality. Certainly folks like me are new to the game. When you talk to the experts in robotics, as we have recently, you realize why there's such a big market opportunity. And, you know, that tends to move this stock, right? It's a narrative stock. As long as we don't have negative data points, and this is like a 10, 15-year horizon, what is the negative catalyst here to kind of put some shade on the stock. So right now we're looking at that perspective, and we like the stock.
So what do you make of Michael Burry's call then, when he says Tesla is ridiculously overvalued? Would you just tell him that you're looking at the future and what's going on with not just robotaxi, but potentially what happens with humanoids?
Yeah, I mean, like, we don't know is the answer, right? I mean, we don't know who's going to win. What do we know about humanoids? We know there's going to be a lot of them. We know that's probably going to be decades from now. We know the form factor will probably be humanoid, and we know Tesla is one of the leaders. So, from that basis, I do think there's enough inertia that should support the stock. Maybe in 10 years or 5 years, we look back and maybe I was wrong, But I just think it's too early to tell, right? I mean, I think the data that Michael Burry had during the housing crisis was real data, right? I don't think we have actual real life data to show that humanoids won't happen or Tesla won't be a big piece of that, or in the robotaxi side either, right? So I'm following what the data that we have presenting before us today is, and I like the odds that Tesla has to capture it, but ultimately none of us really know the answer.
I'm just ChatGPTing or Geminiing how long it's going to take for humanoid robots to do our chores, and they say 5 to 15 years. So it seems like, unfortunately, we'll have to fold our laundry for quite a while. Tom Narayan, thank you so much for taking the time of RBC. It does seem like that is the next step, and it raises this issue of a lot of the manufacturing side of things. That is going to be the source of jobs on the heels of AI for a long time, or maybe 5 years before maybe there's some other alternatives out there.
But he gives this point that a lot of individuals who are very bullish on Tesla give. It's not about EVs. Sure, that's how he made the name and got into the industry, but it's about the future of what Elon Musk views the world is going to be. And humanoids are becoming a lot more popular, at least in the rhetoric, when people want to talk about. And to be honest, 5-10 years is not that far. That's near term, I think, if you look into the future. It's not 20, 30, 50 years.
Do you think that it's subliminal signaling that we're talking about humanoids on Jobs Week when we're not getting
jobs
reports? So there you go. Maybe this is some deep
BLS needs humanoids
message, evidently. Coming up tomorrow, we're going to be talking less about that, more about what's going on right now as people head into 2026. Lori Heidel of State Street, former Kansas City Fed President Thomas Honig, Matt Stuckey of Northwestern Mutual, and Nancy Lazar of Piper Sandler. This was Bloomberg Surveillance. Good morning.